Hey everybody, hope you're all well. Probably not doing well, but just wanted to start a quick space for anyone that wanted to ask anything about the FTX situation. So I'm just going to wait for a few more people to join. And yeah, if you wanted to ask any question, make some requests now. I'll invite you up. But yeah, so Sundays it's a bit more chilled out. Maybe it's still Saturday in the early morning for many of you, depending where you are. Okay, give me a second. I'm just going to get some things together and then I'll do some, I'll let some people up. Okay, so just before I let a few people up, let's just start with a quick overview on where we're at right now. So essentially, I tried to summarize FTX in its simplest form, so people can understand a bit about where we are and what the situation is. But in a nutshell, FTX was people are getting very confused about different regulatory regimes, and what we have noticed is that many people present themselves in a certain way. So, for example, in the Voyager case, they were presented as a broker. Calling yourself a broker is different to being a broker, because when you are a broker, then you have different types of brokers. You have brokers that can just, broker securities and various other things. Or you could be a custody broker where you're able to custody funds, hold funds on behalf of clients, or hold securities on behalf of clients. And these concepts, I hope everyone's starting to appreciate and understand the difference. And so, Voyager presented itself as a broker. And a broker would mean that if it went into liquidation, all of those securities, if it held securities, or all of those funds, if it held funds, would have been segregated from their balance sheet. So the balance sheet is just simply where you list assets and liabilities. And when you're a regulated institution, you need to have, all your assets and liabilities laid out, but you need to segregate clients' assets as well. And segregate means that if your company goes bust, then the assets are not actually yours, which was the Celsius case. So the Celsius case is where it represented itself like a bank. And a bank would be slightly different because with a bank, when you deposit the money at a bank, they own your money. They can spend it as they choose, and they can also create money every time they issue a loan. So in the Celsius case, it was represented as a bank. And when it's represented as a bank, you normally have things like safeguards that came from the last crisis in the traditional TradFi market in the 20s. And in the 1933 reforms, they implemented something called Glass-Steagall. And Glass-Steagall was the separation between retail banking and investment banking. And that was really designed so that you can't take people's deposits and start investing them in securities. And so the more riskier activities were done through brokerage and investment banks, where they could construct securities, and then they could sell them to businesses like fund managers, who were professionals at managing funds, like your pension fund. And so you had these clear separations between investment banking, retail banking, and fund management and brokerage. And so all of these evolved over the years, and they all have regulatory regimes, and they all apply to crypto companies. But many crypto companies kind of thought that they didn't need to follow many of these. So in the Celsius case, they later registered as a money service business, which is just a payment, a payment type of institution. It doesn't hold you to any of the disaster recovery plans, business continuity plans, segregation of client assets, suitability protections, disclosure requirements, all of those come in securities businesses. So, Celsius represented in that way, and therefore there was no disclosure and there was no suitability. And they also, essentially invested your funds in securities, but without any of the securities protection, but represented itself as a bank. And so that's that one. Now, the reason this becomes important, I hope everyone's going to be clear. The next one is, because the way with a bank and a broker, when they go into liquidation, they don't go into Chapter 11. They go into what's known as a SEPA liquidation, which means that immediately another financial institution takes over all the loans, all the custody relationships, all the accounts, the deposit accounts, and the rest is liquidated. And so it's a very fast way of transitioning from one financial institution to the other. So, but that doesn't apply to investment banks. So, for example, Lehman Brothers, that went into a Chapter 11. It was one of the largest Chapter 11s. And it was taken over by Barclays and Nomura, that took on various other, one of the largest banks in the UK and one of the largest banks in Japan. So you have these different types of regimes. Then you have something called like a trust company and a custodian. And a custodian is where when you're simply a storage, is how a bank originally set up. Think of a gold vault. And a gold vault is you open an account with them and you normally have to pay for it, because all they're doing is they're storing their asset for you and they're experts at storage. And a custodian is always meant to be separate. So in the case of FTX, so let's go through FTX. FTX, registers itself as a money service business, which means that it's just considered itself like a payment business, not a securities business, not a bank, not a custodian. But it says that it's going to, in its terms and conditions, that it's going to hold its funds in custody. So let's look at the difference between Celsius and FTX in this case. In the case of Celsius, it says that when you deposit your funds with us, we're like a bank, so therefore we can use your money. And so they invested it in illegal securities that were unregistered, which they called the EARN program. Then if you look at FTX said all funds that you deposit are yours and they're held in custody. And so that means that using those funds is illegal, because they represented themselves as a custodian. At the same time, they have a hedge fund, which is a separate company called Alameda Research. And Sam represents that Alameda Research is independent. The challenge is that when you look, and again, this is real-time information, so we're going to find out in the Chapter 11, but when you look at the way Alameda was set up, it was actually controlling all the withdrawals and deposits for FTX, which was meant to be a custodian. So now you have a hedge fund, which is has exemptions from certain regulations if you only sell it to sophisticated and high net worth or accredited investors, controlling the custody of a money service business, which is representing itself as a custodian. And so therefore, you've got this intertwined relationship between the two, with two very separate regulatory regimes in order to protect client money. Okay, so there's the framework. So let's look at this. Voyager represented itself as a broker, but it wasn't registered as a broker and therefore didn't have any of the protections of a broker to move into a SEPA liquidation, where another broker could just take over the relationship rather than this painful Chapter 11 process. Celsius represented itself as a bank, but invested all your funds in unregistered securities. And FTX represented itself as a custodian, but then used client funds in the way that caused this disaster on their balance sheet. Now, when you couple that with the role of now remember, a private bank has the ability to create fiat currency every time they issue a loan. And a government also has authority, but instead they borrow it from the central bank. So central bank create some digital entries on their balance sheet, and the government issues this security called a bond, and then sells it to the central bank. So rather than the government creating their own money, they borrow it from the central bank, and the central bank creates it. And retail banks create it every time they issue a loan. And so with these cryptocurrencies, essentially that was them creating money, but it wasn't backed by every time you issue a loan. And there's an important part to that. So FTT is an example of money creation, and Cell token is another example of money creation. But then rather than them just being pure money, it's packaged as a security. Because what they do is they say, every time our business succeeds and does more volume, we're going to buy back some of that token, and therefore the price of that token should go up. And so therefore you've connected your token to the performance of the company, which is what Binance originally did, but then got attacked by regulators, so tried to turn it into a new protocol and create their own chain, and try and replicate something like Ethereum, which they could claim is sufficiently decentralized so that it's not a security. And so these money printing have been currencies combined with securities. But because they claim that they're currencies, they don't have to do any of the disclosure requirements, and they're not subject to any of the market manipulation regulations. And so therefore, both FTT or FTX through FTT and Celsius through Cell use the fact that they could print money in order to use client money, because in the case of Celsius, they were an illegal bank investing mainly in illegal securities, and so took that currency and invested it into their own token in order to push up the price so that other people could buy the token. And then we found that insiders also sold their token onto the community, and used it, and then people used the token in order to use it as collateral to take out loans to buy more of the token, in the kind of the flywheel revelation that Dirty Bubble Media revealed very eloquently how it works. And then once you do that, you can then go out and fool a bunch of VCs and tell them, hey, we've got a multi-billion-dollar company here, because what we've done is we've got this asset and we gave it to our treasury. We gave it to our company. We printed a bunch of money, and now we're market making in it. So we're paying other people to manipulate the price, and we're using our client money to manipulate the price. And therefore it's becoming more and more valuable. And as more and more people are using this token, it's becoming more and more valuable. And what we're doing is we're paying market makers, which is another regulated activity. Normally you would separate making a market from issuing. And that would normally be done by an investment bank through a trading desk. And there's all sorts of rules around insiders, market making, and where the tokens came from, and all sorts of disclosures and representations you have to make normally in the securities market. So they do that, and we end up in the scenario where they then go out to all the equity investors and say, we've got this multi-billion-dollar company, why don't you invest in it? And the VCs say, yeah, we'll invest in it, but give us a bunch of tokens too. And so the VCs look for a free equity investment by getting bonus tokens and investing in the equity. And then the VCs get to dump them on the customers with a set schedule. So they'll negotiate a vesting schedule. And so this is, where the scenario we found ourselves in both FTX and Celsius, Well, they probably didn't give bonus tokens. They didn't do the bonus token thing there. But these are the types of things that get negotiated when you get to control the relationship between the market making, the exchange, the hedge fund, the VC, the custodian, the transfer agent, and everything that during the 1920s led to the boom and bust and the Great Depression of the 1930s. That then we had every decade a new financial crisis that led to these new regulations being implemented after experiencing exactly what is happening in our market right now. And so I hope people appreciate that all of these different types of safeguards exist to prevent this situation. So now with that type of information, we can unpack and reverse the balance sheet a little bit more. So if you've just joined, the balance sheet is essentially, you normally have a group of companies. And so if you take a company like Bank to the Future, for example, we have a balance sheet for our platform. And our platform is where we cover all operational costs, we develop it, we earn revenue from fees. And you have a balance sheet there. But our balance sheet doesn't consist of our operational costs plus client funds plus client securities. Those client funds and client securities exist as a note because they're fully segregated, because you have to do that as a regulated securities business. So when someone deposits funds on Bank to the Future, they're held in a custody relationship, so that whenever if something disastrous were to happen to Bank to the Future, then that separate segregated custody of client funds is completely independent from our success or failure. And the same with the securities. We have a separate segregated portfolio company where everybody's shares that they invested in through Bank to the Future exist in a separate entity, so that they're segregated, because as a regulated securities business, you have to have business continuity and disaster recovery plans. So you have to model out your disaster situations, and you have to show the client custody, the funds in custody and the securities are not impacted by whether your company succeeds or fails. And so that's why you have these separate entities in order to get those segregations. And each one has a balance sheet. So we'll have a balance sheet for the funds in custody, and they should match 1-to-1. We owe clients this many, all the different cryptos, and it matches 1-to-1, and it's segregated from the performance of our company. With Celsius, they just did what a bank does, which is where you deposit it and it becomes their asset and their liability. So they start using it as an asset and they owe it to you. And then if their investments go wrong, they're not subject to deposit insurance, which is what you had, which was created as well as through FDIC in 1933. That's another Ponzi scheme because it only covers 1% of all deposits, so it doesn't cover systemic risk, which is why you still need a bailout from government, where they use the bond Ponzi scheme in order to put that up, where the central bank essentially creates new digital entries, and then the government creates some bonds and borrows it from the central bank. So that's the Celsius scenario, and then they have a liability because they owe it to you. Now, if their investments go wrong, you end up with either an insolvency issue if your investments have gone wrong, or you end up with a liquidity issue if you invest the same currency. So, for example, if you took all of clients' ETH and then invested it in staked ETH, and that doesn't unlock for a certain time, or you took, then you have a liquidity issue, because unless it depegs, and if it depegs, then you end up with an insolvency issue, because you can't match the ETH you said you owe the client to the ETH that you had. And then if you then go even further, like Celsius did, and become a venture capitalist, where you invest it in private companies like GK8, and shares in Polygon and 1inch, and then invest it in a mining operation, then you take securities risk, which is where the performance of that investment could go wrong, but you create an accidental Ponzi scheme almost, because if the investment goes wrong, you still owe the client what you promised you owe them. Whereas if you invested in a security, the disclosures are disclosed and the investor takes on the risk. So if you invest in a company through Bank to the Future, we disclose all the risks of that company. And if the company goes bust, you end up with something worth zero, and we don't owe you anything. We owe you the security. If the company like Coinbase goes public, then we owe you shares in a public company, and you get your 100x or 10x or whatever returns, and you diversify widely, so that you have the one or two successes versus the many that failed. Is kind of the idea behind the venture capital model. And so finance is so complex that people think, like FTX, that if they are a money service business or a money transmitter, that they are also subject to many of the rules and regulations of a securities business or a bank. Now, a bank is a complex beast because, firstly, it has the deposit insurance, then it has too big to fail government bailout, but it also has stress testing. And stress testing means that you have to, for example, in the case of FTX, when they marked their FTT tokens, they said that we've got this big asset called FTT tokens, and Celsius said we've got this big asset called Cell tokens, and they represent to the people like Celsius, we've got $2 billion balance sheet, therefore come and deposit with us, we're safer than a bank. They're taking the price of that token and multiplying it by the number of tokens that they hold and own as a company and sit on their balance sheet. But in traditional finance, the issue with Lehman Brothers was that many of those assets on Lehman Brothers' balance sheet didn't have the liquidity because they relied on an over-the-counter market where you would just sell to somebody off exchange. And therefore, in bank stress testing, you have a VAR analysis, which is where you have to discount the asset based upon the volume, rather than market to market, is what they call. And the Lehman Brothers collapse was that they marked the assets to market, but they had a much lower value based upon the lack of liquidity or ability to sell easily. And so, that's essentially, now let's get back to the FTX. And this helps us understand the FTX scenario. So FTX is essentially representing itself as the regulated solution, when really they're setting themselves up as just a money transmitter, which means that you don't have any of the additional protections that we talked about. But in the terms and conditions, they say that when you deposit your money with FTX, we can't touch it, it's held in title in your name. Just like the custody accounts were meant to be on Celsius. Remember, they get a cease and desist order from regulators because they're offering illegal securities, and their solution is to create a custody service and then file for Chapter 11. And so they create a custody service where they said you own it, and therefore all the earned money, we own it. Why? Because we knew that we illegally invested in mining operations and companies and securities, and the only way to protect ourselves is to update the terms and conditions to ensure that those people own their money, because the regulator's asking for a cease and desist order, and everyone else, we own the money, and so with everyone else, we're an illegal bank, but we can solve the cease and desist order issue. And so they said that, but then they commingled the funds and they were invested, so therefore it was in legal custody. So now there's a court case around that. Now the same thing has happened in FTX, essentially. In FTX, and again, sorry, none of this should be legal advice, financial advice, investment advice, tax advice. I'm just a money geek that has invested in over 100 companies in the industry and spent 20 years of my life obsessing over the subject of money, banking, and finance. in a very unhealthy way, and reading, bank legal reforms of bank charter acts for over decades, and studying money for dating back over 5,000 years, and writing a couple of books on the subject, as well as running a company that invests in the industry from the beginning. Okay, so the FTX scenario. So they're meant to have a custody relationship. And so that means that when you deposit your money at FTX, it's meant to be yours. And they're meant to maintain a ledger to ensure that they, in the case of bankruptcy, they can allocate all those funds to you. Then what they did is they illegally took your custody funds and decided to lend it to the hedge fund, which is Alameda. And so Alameda, we're going to find out about their balance sheet and a lot more details. But somehow they grew into this ginormous hedge fund. And it was probably because they printed a bunch of money called the FTT token. And so we'll find out in the Chapter 11 process that relationship and how it was created and who owns what. But this big FTT token is created, and suddenly Alameda becomes one of the big VCs in the market. And so they use that to invest in lots of tokens. And one of the major ones was Solana. And Solana becomes this huge ecosystem for creating non-fungible tokens that leads to a bull market. And they become the number one VC. And they keep investing in more NFTs and more projects. And then they keep on investing in shares of companies, but then getting free tokens so that they can try and dump the tokens on the market and end up with a bunch of free equity. And so they follow the VC model that entered this space. They say, let's get the free equity, or let's invest in the equity and then get the free tokens. We can then dump the tokens on the market when the price is favorable, and we end up with free equity in the company. So Alameda becomes excellent at that. Again, this is all my speculation, trying to get ahead of things. Pretty much what I tried to do with Celsius. Then we can find out exactly what happens as the Chapter 11 filings happen. So you have this free equity positions that they're building, and they're building a bigger and bigger balance sheet. And now they've got a bigger and bigger balance sheet. They can then borrow against that balance sheet and reach out to all the different platforms. So they can go to Celsius, they can go to Voyager, they can go to BlockFi, and they can say, hey, I know that you do this whole business model of collateralized loans, and you ask all your retail customers to put 150% of their crypto, and then they can borrow a bunch of dollars. Well, we're an institutional client. And then Celsius goes out and represents to everybody, yeah, we lend to institutions, we charge them a bunch of fees, and we give it all to you. And we only get 20% and you get 80%. But the institutions, they say, but we've got all the power. We're not going to over collateralize. And we've got the ability to print our own money. So why don't I borrow a bunch of money from you so I can make all these VC investments, and then I can get free equity and dump all the tokens on retail, and then I'll borrow a bunch of money from you, and maybe I'll give you a bit of FTT token as collateral. And depending on the lending company, they would have said, hey, of course, this is Alameda. Alameda's the biggest VC in our market. They're good for the money. We don't need over collateralization. We'll take some FTT tokens. We'll take a bit more risk. They're good for it. They've got a good balance sheet. And so hedge funds like Three Arrows Capital also go out and borrow money from these different companies and then lend it to Alameda, and you get this intertwined relationship. And they've suddenly become one of the biggest VCs in the market. And they go out and they invest in a bunch of tokens. And while those tokens are performing incredibly well, great. And then maybe they borrow more against those tokens as well. Maybe they create marketplaces and invest in NFT marketplaces. And then they just start taking bigger and bigger and bigger bets. And just like we saw when Nick Leeson took down Barings Bank, we see Alameda making bigger and bigger bets, getting further and further leveraged. But they've got this beautiful thing called an exchange. And so with the exchange, Alameda can then do all the market making for these projects. So they can leverage, they can borrow client money, and then they can start market making to push up the prices of the tokens that they invested in. And then they can dump those onto the market at a good price, the sell token Majinsky playbook. So they start doing that, and they become bigger and bigger and bigger, and they end up leveraging more and more and more, because they become degen gamblers. And how did Sam make all his money in the first place? He wasn't a Jesse Powell. He wasn't an Eric Voorhees. He wasn't here for the mission. He was here for the money. He was here for the kimchi premium. And so you put a trader that then brings in a bunch of people to run the company, and they suddenly become portrayed as this multi-billionaire altruist that wants to make more and more money so that they can give more and more away. And then they start investing in real companies. They go out to Elon Musk and say, we'll help you buy Twitter. They try and do a takeover bid of Robinhood. They try and do a takeover bid of Coinbase. Now, thinking about this, remember Majinsky? The whole thing was, I need to be bigger than Coinbase. Nexo is shit. Crypto.com is shit. Coinbase is shit. Everybody's shit. They're all trying to scam you. They're charging fees. And so, FTX suddenly gets the same type of thing as well. And so SBF and Alex Majinsky then get into battle of the egos. Who's got the bigger dick? Start dick measuring. And then we end up in the Luna scenario. And the Luna scenario triggers the House of Cards. So Do Kwon comes along and says, I can print money. And you know what? I can back it all by a token. And then I can back that token. And then we have a balance sheet, but I'm going to start diversifying into Bitcoin. So they all have these balance sheet that relies on the market continually going up, and the good times rolling. And that blows up. And then they all get together in a meeting, which will all be revealed in the examination reports, to try and figure out what the hell they're going to do. They all start rivalries with each other. Binance is also exposed. Binance invested in FTX. Binance was started as a pump and dump shop. I remember because I was there, where they were charging 150K for market making and listing on their exchange for any token, offering illegal securities. And their token happened to do well through the model. And then they started offering, people could list for 10 million. It went from 150 million to 10 million, where they do all the market making. You've got to give them a bunch of free tokens, then they dump the tokens on the market. And that's how they started. They didn't need banking because they used Tether. And then over time, they make a lot of the right moves, and create a flywheel model successfully. They become the only one that actually pulls it off. And over time, they keep changing everything, but they invested in FTX, and Binance then suddenly discovers these things, and decides that they're going to throw FTX under the bus, using their balance sheet, because they managed to diversify out. They didn't borrow against their token, and they find themselves in a strong position. And so then we get the series of events. We know what happens next. We have the Luna collapse that exposes Three Arrows Capital. Three Arrows Capital creates contagion across Celsius, Voyager, and BlockFi. And then FTX suddenly realizes, and Alameda suddenly realizes, holy shit, we're fucked. What are we going to do? Well, we've got to reach out. We've got our reputation. We're known as the biggest VC in the industry. We're known as the most reputable exchange in the industry. We've got all the relationships. We managed to get all the VCs in. They managed to dump their tokens. So what are we going to do now? Well, we're gonna save the industry. We're going to borrow against our balance sheet and our client assets, and we're going to show that we have the liquidity and execute a JP Morgan strategy. And the JP Morgan of 1907 panic strategy is demonstrate your balance sheet so you can buy the companies up for pennies on the dollar, and then you can try and fill your hole. So Alex Majinsky's strategy was take client assets to fill the hole. You got this big hole of all these things you did wrong. Let's take all that money and invest it in a Bitcoin mining operation and take the company public. And if the market goes right, then we can try and fill some of the hole. So he bet long because he believed that the market was going to continue going up, and ended up short Bitcoin. And so the same with the FTX scenario. The FTX scenario is that they needed to fill their hole, so they need to get more and more speculative, and they need to use their assets. And then rather than writing off those loans, which would take them insolvent, they simply try and use financial engineering to say, we'll buy BlockFi and we'll unwind the loan. The FTT tokens come back to us, and we get to plug some of the hole and mark those assets to market, as long as the market hasn't crashed and everyone believes that our token is kosher. So then they start to unwind some of these loans and acquire the companies so that they could then take the long-term equity value of those companies and plug some of the hole. Then he tries to do it for BlockFi. He executes that, and that gives him the license that he needs, because they negotiated with the SEC when they got their cease and desist order that they're going to register as a securities business and start implementing security protections. Voyager, they try and do the same, but it goes into Chapter 11 because it has the big hole from Three Arrows Capital. And so then they go into the bidding process and try to do a predatory offer where they take the whole thing for $15 million and get it for free. Or they buy the company for $51 million, but portray it as $1.4 billion, dollarize all of the crypto, and then they essentially get the benefit from the Chapter 7, which then starts to fill. It was basically a liquidation done through a bid. And rather than give all the clients their assets, we can use that to fill some of our hole. And then they try and do the same with Celsius, but then Binance comes along and screws up the party. Binance starts to... Why did that happen? Well, in the Voyager bid, it was Binance and FTX and Crosstower. And with the Binance scenario, they clearly had the stronger position to win. But SBF decides that it's time to use politics and dirty tricks, and starts lobbying against Binance, saying that it's a Chinese company, and playing the geopolitical game and contributing to the existing leadership and Democratic Party, saying, I'll make sure Trump doesn't get back into power. And plays the bankers game and takes it to the next level, and then tries to implement laws and regulations that make DeFi impossible, and centralized exchanges upgraded to some of the types of things that should happen at the banking side or the brokerage side. But Binance doesn't like that, and so Binance makes their move and exposes, and ends up with all the net inflows. And then everybody realizes that there's a liquidity issue for every single company. And anyone that's investing in illegal securities like Nexo is, like Crypto.com is, like all of the crypto lending platforms that are investing in security, that are taking your money and calling it a deposit and investing in securities that are all subject to the exact same business model where they don't segregate and they haven't disclosed the risks, they all end up with runs on their bank and everybody's withdrawing and trying to get into cold storage and get a hardware wallet as fast as they possibly can. And all of them are subject to the same thing, and they all have tokens that are crashing. And we don't know whether they did the SBF FTX model of leveraging their tokens yet. So wrapping this all up, let's look at the balance sheet now. So what do we know right now? Well, FTX has essentially loaned billions of dollars to Alameda. And Alameda has been playing market manipulator and VC fund and hedge fund with all of these projects, and essentially has lost a shit ton of money. Alameda then decides that they're going to print up the FTT token, or FTX. We'll find out the exact relationship in the Chapter 11 process. And then they're going to use it as collateral to borrow your money that you deposited with FTX. So now they breach the custody relationship, which is why they're getting the criminal investigations. And they give instead FTT tokens that Binance gets a look in on this relationship as both a shareholder and somebody that was going to try and fuck them based upon the fact that SBF paid these dirty tricks to try and take Binance out of the Voyager bid. So then you have this FTT token, and the whole thing depends upon the FTT token continuing to go up in value. They raise finance at a 32 billion valuation and wipe out all the equity holders in the Chapter 11 process. Celsius does the same thing, gets both of them get the Canadian pension fund money to come along and invest in their equity with the belief that their balance sheet was marked to market based upon their token. And therefore, the Celsius gets a $3 billion valuation. BlockFi gets their $4 billion valuation. And Voyager gets their $6 billion valuation in the public markets in Canada. And Celsius gets their $3 billion, and SBF gets their $32 billion. They sucker in all the equity investors based upon their balance sheet. And they then start to use, in the case of FTX and Alameda, they start to use the token in order to try and win the bids and fill their hole by buying all the companies that they destroyed with their bad debt. Now, what are we left with? Well, if we can read the reports that we currently see, FTX, which is meant to be a custodian, is reported, and this is just from the public news, we'll get the real numbers in Chapter 11, that they owe you $9 billion. And they've got 900 million. Sorry, they owe you 9 billion, and they got 900 million allegedly of liquid assets. We don't know what illiquid assets had. My guess is that FTX doesn't have much because they're all probably siphoned off into Alameda. Alameda holds all the assets, and FTX owes you 900 million or $9 billion. Then what happens? 600 million of it gets hacked. So you're now down to $300 million on a $9 billion balance sheet. Binance says, no, I'm not filling that. I'll get you either in Chapter 7 liquidation because it's crime. I don't need all that crime. We've got our own issues. We're getting cease and desist orders from regulators from all the shit we've been doing. And we don't need your issues as well. And so now the clients have to pay because he breached the custody relationship. And where are we left with right now? We're left with, let's fricking hope that Alameda actually made some good investments. Because they would have had a bunch of equity. Their tokens are probably all gone to shit because they destroyed the ecosystem and over leveraged it. And hopefully there's something of value left on Alameda's balance sheet. And if so, it's either going to go into Chapter 7 liquidation and destroy the market further, take more of the Bitcoin miners out, send more companies bankrupt, crash all of our cryptocurrency down further, wipe out all the retail, and then leave just the rich people that can scoop up all of the cheap Bitcoin to come along. Or we're going to fight to make sure that all those assets don't get liquidated. They get given to creditors, and all those securities also get given to creditors, so that in the next market, it's not just the rich people that scoop up everything that benefit from it, or the shareholders from the companies that end up buying all these assets in auction benefit from it. We have to fight to make sure that all the creditors and the victims benefit from it. And that brings us exactly to what we've been fighting for in the Celsius bid, which is the ability to bid and give all the assets, knowing that regulators might give us a chance to do it. Because they sure as hell ain't going to let any of these companies reorg and come out of Chapter 11. That's a fact. And so that brings us to where we are today. So I'm really, really embarrassed for the industry. It doesn't change any of the fundamentals of Bitcoin and what we've worked so hard to build over the years. Dedicated since 2011, over 12 years of my life to try and invest and support this industry. And every 4 to 5 years, we get these cycles, and then people start to confuse decentralized regulations of cryptocurrencies with the need to regulate centralized institutions to prevent such shenanigans that then affect all of the innovation that everybody's building and investing in. We need DeFi to persist. We need Bitcoin to persist. Bitcoin will survive. And we need regulations, the effective and appropriate regulations within the centralized companies. The one thing and the only reason we've survived every cycle is because from day one, we decided that we would do this in line with securities laws and give effective disclosures and only take on suitable investors. And through all the trials and tribulations, that's allowed us to survive. And even if we fail, at least the segregation of client assets is held in custody, and the securities are held segregated so that we don't risk our investors' future based upon some of the things and bad or good decisions that we may make. So that brings us really full circle to where we are. You're going to hear a lot of spaces, a lot of people saying, we don't want regulations, we do want regulations. People are going to say everything should be DeFi and we should get rid of these centralized companies. Everyone's confused because they're applying their one map of the world that they understand to different contexts. We will get central bank digital currencies. We will have centralized companies that need regulations in order to perform. And you will get TradFi coming in as well. And the only reason that's kept them out is because they haven't been able to compete with companies that have managed to grow and scale so fast without all of the checks and controls. And there's one big freaking problem that I've seen over the years. Whenever a company grows so fast, so big, so quickly, just like Celsius, just like FTX, they're normally cutting corners. And you just can't. I know firsthand from building banks of the future, the years and years and years of sweat and blood that you have to put in order to follow and comply with the regulations while supporting innovation. And that takes time. And it's the same shit that we have in our industry. People trying to make money too fast, blowing it all up, and the long-term investors prevailing. So if there's anything that we get out at the end of this, my hope is that everybody will decrease their time preference, stop trying to make that fast buck, companies, countries, individuals, and we start putting some sustainability into this, because we do have digital hard sound money. And if that gets affected, and the tax that are going to follow, no one ever said it was going to be easy. The governments are not going to make this easy. They're going to make this shit hell for us as a result. But in these processes, we have an opportunity to show them the correct regulations, allow them to get what they want, and make sure that all the assets go to creditors and not to predators. And that's the only way that we're going to recover from this. And it's going to take a few years, and we're going to be in this journey together. But if you look at the history and if you look at the cycles, I don't think anything's different here, other than the traditional financial system is also going through a change in empire and a massive shift at the end of a debt cycle, which is actually the exact reason why Bitcoin exists. Money you can own on your hardware wallet, money you can spend, so that rather than having middle people decide whether you're a criminal or not, law enforcement have to do that through the blockchain, and money that has a fixed supply so you can counter inflation and protect yourself from governments always trying to win votes by printing more money and satisfying the whims of voters in a system that drives wealth inequality, and resets itself at the end of every debt cycle and leads to the destruction of fiat currencies predictably, inevitably, and guaranteed, and the destruction of people's wealth that don't manage their finances effectively and protect for different outcomes. Okay, I was just going to give a Q&A, but I'm so wound up by what I'm seeing right now and what I'm experiencing that I wanted to make sure that people understood the complete picture here. Okay. All right. Okay, so I wasn't even looking. We got Mary here. Mary, I'm going to make you co-host. Let's chat to some people.
Good morning, Simon.
Hey, Mary, how you doing?
Good, how are you?
Yeah, good.
Thank you so much for having this space. We've got a lot of requests coming up.
Awesome. It's really late in America, right, as well?
Yes.
Sorry for the timing.
No.
I'll make sure I put it on YouTube.
That's fantastic. So many people are looking for information, and it's important to get the right information out there.
Okay, let's bring some people up.
All right. It's connecting right now. Anan?
Hi, Simon. Hi, Mary. Thanks. Can you hear me?
Yes.
I can hear you well.
Yeah, Simon, thank you so much for elaborate overview. Having been in this space and having gone through all the saga from Luna, I couldn't actually even say something that you said is exaggerated or out of facts or something like that, right? It almost appears like spot on your analysis. I do have a few questions. I'll try to be quick given we have many audience here. One, I'll refer to the word psycho. So where is the jurisdiction of legal proceedings against him? That's number one. And second thing is having equity as well as trying to get some tokens through VC investment. Is it within the legal framework? Third, this guy having a vested interest within Alameda, is it not a conflict of interest?
Yeah. So thank you for those questions. So there's two ways of solving these things. There's ethics and there's regulations. Regulations exist in order to try and hold people accountable, but also regulations can be corrupted as well. So you get corruptions and corruptions within institutions. And so the way to solve most of those problems is by either having ethical players that really have a governance structure that holds them accountable to a higher standard when we all as humans slip on our standards, or we have enforcement through having to do stuff, and that accountability makes you hold yourself to a higher standard. And all of those three things that you just said are about legal and regulatory ways of enforcing what's right for the investor. And over the years, I've seen some incredibly unethical players. I've seen some ethical players that find it harder to execute. And when backing a company, you need both ethics and competence. And that's the killer combination. Every time I've deviated from that or got tricked on that, I've ended up with a bad investment. Every investment that's gone well, I look back at it and it's got that combination of the ethics and competency. So going back to the questions, is there a conflict of interest? Absolutely. The reason regulations exist is to remove some of those conflicts. So in the traditional financial system, you can't have an exchange, an investment bank, a fund manager, a corporate finance, a market maker, a transfer agent, and a custodian all be in the same person or company. And that's why traditional finance is more expensive. Blockchain was meant to take out the transfer agent, and proof of reserves is meant to take out the need for custody eventually. And the exchange and market makers and hedge funds and all that, those should all be separate. The buy side and the sell side is normally separate. And in traditional finance, it fails all the time, but we have something called a Chinese wall. So when I worked as a market maker at an investment bank, and I also worked in corporate finance, my job in corporate finance was to take companies public. And when a company was, or do a merger or an acquisition, and when a company was going to be taken over, that affects the share price. So when I worked in market making, the corporate financiers were not allowed to come over and tell me that there's an M&A transaction, because that could affect how I make a market in that price. Now, it happened all the time, but at least it's illegal. And then you have all the insider trading as well to remove those conflicts, because if you're a director and you have superior information to the general investors, then the way to combat that is to have rules around insider trading and market manipulation where these things can't happen. And you have to disclose as an insider when you're selling your shares so that people can make their own decision. And you have to give a reason. And you might be that, I want to go buy a house, or it's because I no longer believe in the price of the stock anymore. But the information that you give has to be honest, and you have to be accountable to it as well. And there's always scandals. I'm not saying it works, but at least whether it's there, and the ethical players can say, yeah, I'm not willing to go to prison for that, and the unethical ones can say, well, I'm willing to take that risk or I don't think it's that bad. I think it's bad regulations. Okay, and you either reform the regulations or you break the regulations. And this is an example of all those conflicts. Can somebody invest in a token and an equity? There's nothing that I'm aware of. Again, I'm not a lawyer, that prevents that from happening. Should it be disclosed? Absolutely. I think we've tried to do that in the industry, and that's where the whole ICO thing, both boom and bust, won't happen, because the VCs weren't disclosing and dumping. And there's a big problem with liquidity. This has all come because of liquidity. And what does liquidity do? It moves when you start a venture. Everyone on Bank to the Future is a long-term investor in the companies. It took us years for Coinbase to go from a startup to public. It took us years from Kraken to be valued at 20 million when no one would invest to 20 billion when they're looking to IPO at some stage, depending if the market recovers. Those take a long time, and there's a reason why, because it's a forced hodl. And the wealthiest people I know in this industry, they kept their Bitcoin all the way through and they didn't trade it. And so private equity is a forced hodl. Now, the crypto industry comes along and says, forget securities laws. Let's give everyone instant liquidity when they raise finance for projects. And that brings out the worst in human nature, because you're taking people from a low time preference to a high time preference. And when you have a time preference that gratifies instant returns, you get pumps and dumps. You get people in the market not for the mission; they're just here for the dollars. And you get players like FTX that use all of those practices, spoof trade, bots, all sorts of stuff, in order to create all of those shenanigans. And so liquidity is actually the issue here. When you're investing in an early stage venture, it's not meant to be liquid. And if it is liquid, then you have all the public company rules to try and prevent as many shenanigans as possible. And hopefully, and that's why it normally comes at a later stage. But if we're doing it at the early stage, then we're going to certainly need rules and regulations in the same way. Because if we think that they would only do those actions in the traditional market and they won't do it in the crypto market, than we're deluded. The technology could be done differently. It could be done through tech eventually. It could be code. We can still try and work for that. But remember, there's problems with blockchain and code as well. You can always have a legal off-chain agreement that supersedes what you see on the chain. And we've already seen that. So crypto.com, they were trying to do their proof of reserves, and they ended up sending it over to Gate, and less money comes back. And the CEO has to come on and explain that and said, yeah, we accidentally sent it to an exchange rather than cold storage. What's that all about? What additional agreements were existing between the exchange and the company sat on top of that? And so sometimes blockchain can create an illusion of transparency when there's dangerous shit happening in the background off chain. Anyway, okay.
Thanks for your
No,
question,
that's
Andy.
Mary, I'll just take 30 seconds. Sorry, don't mind. The company as well as the investments made in the fiat world obviously does not exist on chain, right? So definitely those operations are definitely not transparent, even if they claim so, unless verified. Simon, can you please also touch upon where the jurisdiction of taking legal action on Sam exists? Because he first said he's running offshore operations with FTX International. Later he said FTX US as well. So where is the legal jurisdiction of this guy?
The honest answer is I don't know yet. My understanding is that he's currently in Bahamas, and he has companies that operate. Now, the important thing with jurisdiction is it's not necessarily where your company is, it's where your investor resides. So if the FTX US has US investors, and also they filed for bankruptcy within the US court. So again, you need to get your own legal advice. But what I can tell you from the Celsius scenario is that people wasted a bunch of money on class action lawsuits and various other things. And then when they're in Chapter 11, it just went into protection anyway. And so they get protection from those lawsuits, but individuals may not from the criminal side. And so I can't give you legal advice, but the experience from Celsius is that you need to just play the Chapter 11 process and then leave all the legal stuff for later. Here's why. If you, at the moment in Celsius, there is an examiner that's investigating and the judge is asking, was Celsius a Ponzi scheme? And if that becomes true, or the examiner determines it, the examiner actually said, I don't want to determine it, but I'll give you the information you need to make your own determination. And the reason they're doing that is because if it's a Ponzi scheme or criminal or fraud, then it's going to move to the worst outcome for everybody and just a big liquidation of all assets that crashes the market, crashes everything. That doesn't mean you won't get justice in the end. So in the Chapter 11 process, you want to get, to get a better result, you need to get it through a bidding process where you get whatever crypto is left, and then a security where you get benefit to any upside on all the things that were invested with your money. That's only going to happen through a bidding process, because there's no way that they let anyone that does any of this reorganize and come back later. Because then all the regulators will just try and shut down the reorganized company based upon the actions of what happened before. Or they'll just take years and years and years delaying it in order to get the license that they may need. So unfortunately, your instant reaction might be that, but think about creditors first. So if you've got money that's owed to you, you probably get a better result engaging in the Chapter 11 process than trying to prove that SBF is a criminal. You will get that in the end. Now, remember, there's an asset you can have as well, which is what we're trying to do with Celsius is construct a security where any recourse based upon inside of those investments and anything that came back can be an asset of the estate. So this is going to take a long time, and you don't want to delay you getting your whatever's back in order to try and get revenge, because that can come later. That's, again, my non-legal advice. You have to do what you think is right for you. Thank you.
Thank you. BTC?
Hi, Simon. Hi, everyone. Thank you, Simon. it's been a long 36 hours for a lot of us who have been on these spaces. I was on Mario's for, I think, 24 hours yesterday. Can I just ask you one quick question about traditional sort of markets? The M.2 money supply, as we know, has gone vertical. You obviously, you know a lot about banking. You've studied banking. Is this anything that, can you foresee what's going to happen over the next few years or whatever, with the amount of money that's in supply and the amount of money that possibly is about to be introduced into supply, let's say in 2024? If a certain party wins an election, and then the only way to sort of fix the mess is to throw more money at the mess, if you understand what I mean. Thank
you. So I don't do short term, but I do long term. And so in 2009, I uploaded a video to YouTube called The Great Depression of the 2020s, which tracked these economic effects. In 2020, I released a video series on www.retirementplanb.com, where I gave an update on the Great Depression of the 2020s and got everyone ready for inflation, deflation, economic growth, economic decline, bank failure, pandemic, wars, and gave an overview of a portfolio and invested $1 million live to show them how I did it, to be protected from those outcomes. So my long-term trend, and I covered it in my book, which I wrote, Bank to the Future, Protect Your Future Before Governments Go Bust, and I was writing a new one to give the answer to that exact question and get people ready for the next decade or a couple of decades ahead. Unfortunately, I got distracted with the Celsius Chapter 11, and sadly, my father's passing. But I'm writing a book on that topic as soon as I get back to it. But in a nutshell, yeah, we've hit a point of inflection. I believe that we're at the point of a changing empire, and at a changing empire, you get real strength through the uncertainty into the existing world reserve currency, and then a slow decline of the empire over a couple of years. And if that decline leads to extreme left and right popularism, then you normally get the election of a very extreme political environment, which we're seeing in the US. And so with the acquisition of Twitter by Elon, I accept Trump's account to be re-enabled. I expect him to win the election in 2024, and I expect him to be the fall guy for the change of an empire. But the currency normally takes 20 years longer than a change in the size of a GDP. So you'd expect a 20-year slow decline, and that's normally caused by hyperinflation, or an inflationary environment, or you end up with an extreme military war. And a military war normally ends with a monetary renegotiation. So if you look at the dollar, it started with the World War One, where America funded much of the war but didn't have the war on its own ground. And so they negotiated in 1918 at the Treaty of Versailles that the debts of the losing parties would be assumed by America and Britain, and they'd have to pay in gold. And so that led to a massive amount of gold that was confiscated from the slave trade by Europeans, that was essentially stolen from African countries. That slave trade gold ended up in the coffers of the Federal Reserve and the Bank of England as a result of World War One. Then it went into World War Two, and then after World War Two, there was the Bretton Woods negotiation, where again America was less harmed, and therefore it was the beneficiary because it had the access to the gold. It had an agreement between the Bank of England and the Fed, and Britain was essentially bankrupt because they were a falling empire. And so they ended up with a negotiation between the Fed and the Bank of England, and then the Bretton Woods. And so the dollar was negotiated. Britain lost because John Maynard Keynes was trying to negotiate a world currency called Bancor, and that lost. And you ended up with the dollar and everyone coming off the gold standard and pegging their currency to the dollar, and the dollar agreeing that it would peg its currency to the gold at the Fed. And then obviously those agreements went to the point where a lot of that gold was leaving America, because as you become more of an empire, you get more lazy, and cheap labor goes abroad. And the gold standard always checked and controlled people's debts, and debt was increasing in order to create the capital markets in America that took out the British capital markets, that took out the Dutch capital markets before that. And that led to the removal of the gold standard by Nixon in 71, and then the full fiat standard. So we're now 52 years into the full fiat standard from 1971. And in 2022, they removed they essentially sanctioned Russia's central bank, which meant that now officially the dollar you can't own, you can't spend. And by in the international markets, and it's not backed by gold, and it's if its supply is increasing at a faster and faster rate, and is essentially backed by a test of the military power of America and NATO from Russia and China. So to me, that's you get this increasing and increasing and increasing debt cycle that I covered in that video. And so that's why the importance of this industry is so important. So I always go in long-term trends, but I think at the end of every cycle you get a monetary renegotiation, and I think this monetary renegotiation is going to be central bank digital currencies, and the trigger for it is going to be when the banks are over leveraged and we expose the real estate bubble. And the real estate bubble has always been, it was never solved since 2008. And then you've got the credit card and pension issue as well. That leads to some bank failures. And then a bank failure, FDIC only covers 1% of bank deposits at the moment. And so a run on the bank and a bank failure can only be fixed by either central banks or governments printing money, much like Abraham Lincoln did during the Civil Wars. They printed the greenback and their own money rather than allowing banks to create the money as debt. And that's really an attack. A central bank digital currency is an attack on the banking system, because you're removing their ability to create money, and then they'd have to become custodians and peer-to-peer lenders. That's the model I talked about in my book, Bank to the Future. That's the model that's come into the future of the crypto industry. And that's the only model, but the cost of that is essentially the removal of freedom, privacies, and communism on a blockchain is what I call it, a CBDC. But then you need freedom on a blockchain, which is Bitcoin. And so we've got to fight these two different trends. And hard money is always where people go in the change and shift of an empire, and a monetary renegotiation. Everyone always goes to hard money. So in the past it was gold, but now we have Bitcoin and gold. Sorry, long answer, but it's a bit geeky on a Sunday. I like to geek out.
Wow. I was tired 5 minutes ago. Now I'm bright-eyed, bushy again. Thanks, Simon.
Pleasure.
You're like a walking history book there. Great lesson. Call me Q.
Yo, Simon. Hi, Mary. Hi, everybody. Simon, exceptional analysis. I could tell you're a corporate finance guy. I really appreciated that analysis of the balance sheet. I watched an interview last night, SBF, Eric Von Hees. I had a number of questions, and I want to pose this to you as somebody that's been in the industry for a while. Look, you know as well as I do, having listened to your analysis of a balance sheet, liquidity is always an issue only when you gear. You have liquidity issues when you use up more than what you actually have. And it's surprising to me that someone like this was able to do what he did with players like you and some other, clearly very sharp people, because it seems to me that SBF somehow managed to use all the upside of a decentralized ecosystem to do exactly what the banks do, because this is exactly what the banks do. We know this as fractional reserve banking, right? You know about Brenton Woods.
It's worse because you don't have the protection as well.
Precisely. That's why I said he used decentralized mechanisms to do centralized things. He basically printed money, which is why we're here in the first place. We don't want people creating fictional liquidity, because then what's required is that someone needs to print money and therefore dilute the existing amount of money that's in the ecosystem. So that's why I say I don't know how this person, and I mean, if you watch that interview, it's a 2-hour interview, and Eric just absolutely tears him apart. I mean, this man doesn't even give one concise answer. So that makes me wonder how, quote unquote, the OGs missed this guy and didn't call him out for what he is. Okay. So that's my first question.
Okay, let me take that one at a time, because I always forget the second one.
Okay, cool.
Well, in that example, firstly, yeah, I get moves wrong all the time. So I'm not a creditor in FTX. I was a creditor in Celsius, and actually Celsius were the community that probably called out SBF, because they were trying to defend their leader by saying it was SBF's fault. The Celsius narrative came out that it wasn't anything that Alex did, it was SBF. And so it was a pretty skeptical thing. I came to the conclusion it's both, and they both were in it together. But some people like to take the narrative in order to pump the price of their sell token. And there was a squeeze going on, so it fed into their narrative, which got them wrecked anyway. Yeah, so I am a shareholder in Eric Voorhees Shapeshift, for disclosure, and I'm not a creditor in FTX. So, but I did get fooled into, because I had a strategy, and my strategy was that you have spending money, which is fiat, you have savings, and then you have investments. And part of my investments was leveraging some of a small percentage of my portfolio, and no more than 5%, and only 1% of it was on Celsius, where you can take some of your Bitcoin, put it at risk, receive a yield that would pay for a loan, so that you can have fiat spending money to cover lifestyle. I'm still okay with that, because it was completely risk managed, and I factor into my model the blowing up of some of these companies. But still, with hindsight, if I had gone back and done the due diligence and watched all the AMAs, the team did the due diligence at the Series A funding round, and then everything significantly changed and the model deviated, and we caught it in the Series B because that never got completed. And that's when I had to kind of call out once the pause happened. But yeah, it happens to the best of us, and diversification is the key. And hopefully everyone will learn that. But it drives everyone back to Bitcoin, cold storage, and diversification in the end. And I'm really, really looking forward to, in 2023, like taking all of these lessons and creating one of the largest community of people that really build a 10-year plan, and are not exposed to any of these, and try and use the assets from all of these Chapter 11s to build a recovery plan for creditors in any way I can. It starts with Celsius, and then we'll see what we can do. But yeah, it is shocking, it is surprising, and then you go back at it and it's blindingly obvious, right?
Yeah. But hindsight's always 2020. I appreciate that honest answer, Simon. I got a second one for you, which you already touched on. So the two were linked, and it sounds like you look at it the same way. And the Bitcoin maxis in the room will probably get upset at this, but I look at crypto assets the same way I would look at any portfolio of call it equity and or fixed income, right? So you have a staggered approach, or you have a tiering system: mid cap, small cap, large caps, blue chips. And then there's the tokenomics, right, which is the highly speculative, highly risky stuff. Well, it's become that, but it's clear to my mind that the original builders had an ideal in which these tokens, now coins and various proliferations or various variations of them, were supposed to be used to finance some of the more esoteric, call it riskier, and maybe even some of the more isolated projects around the world, right? And using the system, which is underpinned, I think we should all agree, by Bitcoin, right? So if Bitcoin is right at the top of the, if Bitcoin is right at the top, right? I imagine a system which someone in an emerging market can actually use the, call it, more riskier tokens and work their way towards a Bitcoin, right? So think of it as trading your way up.
Yeah, no, I do the opposite. So I
Okay.
start with Bitcoin.
Okay.
So I create my own balance sheet and my own cash flow. This is what we do with all our investors at Banks of the Future. We start with a balance sheet and a cash flow, and then you figure out how much you need and what debt you need to get rid of, or whatever you need to do to get in a position where you spend less than you earn and can invest the difference. Then you put the difference in savings. You start with savings, and savings to me is hard money. And there's only two forms of hard money in my book: Bitcoin and gold. And then you generate a wealth effect that takes you to your investing, and you dollar cost average, so you don't have to trade and time the market. And then your investing portfolio is where you can do the more speculative stuff. And what I do is I built Bank to the Future because I wanted to invest in all the companies that built the ecosystem that made Bitcoin better. And so we invested in all the exchanges because in equity, long term, because I'm not looking for a quick pump and dump. I'm looking for long-term value that's going to make many times returns. And so my investment portfolio consists of equity, and then many of those equity companies benefited from tokens or released tokens. So in the case of Shapeshift, it issued tokens and shareholders get tokens. In the case of exchanges, they have to adjust to every trend because they benefit when the market goes up and benefit when the market goes down, and they have bad times when the market's sideways. So you get complete exposure to the growth of the entire industry when you own shares in exchange. I'm not talking about the fake tokens where they create an illegal security that then blow up the whole thing. And so if you start with speculation through trading, you get lucky or not, and most people don't get lucky, or they get lucky and then blow it all up and never get to the saving stage and do it in reverse. So I start with fiat currency, refactor your personal balance sheet, and then determine that you're going to invest every single month in the exact same way. And then you put together a savings, and then the savings generates you wealth that you can either leverage to get more spending money as your wealth grows at a small percentage, or you put all into your investment portfolio, and eventually your investment portfolio pays for all your income and your spending, and then you never have to work, and you only work because you choose to. That normally takes a 10-year plan to pull off. And so it took me from the beginning of Bitcoin, when I was deep in debt, and my wife persuaded me to go to the first Bitcoin conference because I'd left investment banking, and I tried to create a bank and almost went bankrupt in the process of trying to create it. But we got a plane ticket to the first Bitcoin conference because I was writing the book on the future of banking, and I wanted to launch it at the first Bitcoin conference, and we were trying to create that bank, and we realized that we couldn't create it because the regulators required us to deposit 60 million at the Bank of England. They said we had to use the infrastructure of an existing bank, and we wanted to create the ability for people to own their own money and hold it in custody, and then not rehypothecate. But they made us rehypothecate because they said we had to use an existing bank in order to build our technology on top. So any funds deposited with us would have rehypothecated in the banking system. And so when we realized that we were going to fail, and they also wanted me to step down as CEO because they wanted someone that had 10 years experience at being executive of a top retail bank, and they were going to recreate the same system. We found Bitcoin, and we realized that money you can earn, money you can spend, and money has a fixed supply was being created. And so we invested in our first Bitcoin at $3. And we kept building our savings and contributing every time we earned some income. We'd buy some more Bitcoin, And then we kept doing that, and the Bitcoin became more and more valuable. And then eventually we were able to leverage it and build our business, which was Bank to the Future. And Bank to the Future became a securities business where companies that couldn't get VC funding, like Bitcoin companies like Kraken and all the early companies that were trying to build the ecosystem, could pull together their money. So we were able to leverage our wealth in order to invest in the business, and that's an investment. And then I was able to use Bank to the Future to pull together my money with all the other Bitcoin community's money, and then invest in all these things to a fixed percentage. And then I kept doing the same thing every month, and never being in a position where we needed to sell our Bitcoin. Even the business would accumulate Bitcoin and as fees, and then make sure we earned enough dollars, not by growing too fast. And then we'd spend the dollars on our operational overhead, but we keep the Bitcoin as an asset. And we implemented the Bitcoin standard within our company and me as an individual. And then we wanted to do it at the country level. So we found the first country, Isle of Man, that wanted to make Bitcoin legal tender. And we reformed security laws in the UK so that people could invest online. And that opened up the platform to more people. But unfortunately, they'd only let us work with UK investors and UK businesses. And so then we went to Isle of Man, and then the Bank of England said, if you support Bitcoin as legal tender, we'll remove clearing to your island. And so then we went to Iceland, and we set up the first mining-backed security. We got our regulations and regulatory reforms. Obama reformed the US law based upon what we did in the UK to make non-accredited investors be able to invest through the Jobs Act. And then we just kept investing more each month in the fixed way in savings, which is Bitcoin, diversifying with some gold, and then investments, which is more riskier assets. And then you can leverage your more riskier assets as your wealth grows and manage it in an effective way with a good balance sheet. That's really the story. And so doing it in reverse, most people try and trade their way to success, and they never get out of the trap because they put together a 1-year plan rather than 10-year plan. Sorry.
Well, it sounds like we're saying the same thing, and I didn't want to interrupt you. I wanted you to complete your train of thought. Here, it sounds like we're saying the same thing, but from different perspectives. It sounds like you're saying that you're using, and again, this actually goes against what a max, I would expect a maxi to say. I don't know if you would classify yourself as a maxi, but it sounds like you're saying
I'm a hard money maxi, and I believe investing in securities.
Okay, so now you're saying to me that you use Bitcoin as your store of value then. Mm-hmm. So then you it sounds like you're saying to me, yeah, which is what I meant, right? So one of the key issues, or where central banks have fooled us, is M1, M2, M3 money supply, which is the velocity of money, right? So they make this argument, and this is where trickle-down economics comes from. So they make the argument that sometimes you don't need as much money as there is in the system. You can fool the system by actually sloshing money around and quickly pulling it in and out and moving and making it appear as though there's more money than there actually is in the system. So what you're talking about is, to my mind, the same concept, because you're saying, listen, I want to store my value in Bitcoin, which I would agree with you, because if you just do the simple math, 21 million in total supply divided by the total number of people in the whole world, it tells you exactly where this whole thing is going. So you want to accumulate Bitcoin and you want to slosh around call it the cheaper tokens. And this is why I say, or my theory is, for someone at the other end of the spectrum trying to work their way towards wealth, i.e. Bitcoin, right? To my mind, it makes sense then that they would do all their risky stuff in these tokens. Where I have an issue is if these tokens are not used to do productive or sustainable things. And this is where this SPF thing completely infuriates me, because these tokens were not meant to do this. These tokens were meant to create, call it altruistic businesses that have a more sustainable, to my mind, ideal. Right, so I think we can all agree that we don't want a DAO that's going to be focused on doing nefarious things. I think that's one thing that we can agree. Like, if we're going to do regulations, or first thing we're going to regulate is that if an organization is going to be autonomous, it cannot be not autonomous in the wrong direction. I think that's not complicated. We can all agree, right? So it stands to reason then that the purposes of DAOs is to do altruistic things. And so that automatically means that whatever token that you make needs to move in that direction. And you can't use a token to do banking stuff.
I think this is a really interesting conversation. We could really go back and forth because it's such an interesting conversation. Let me try and summarize it because there's quite a few people that want to go up. But thank you so much for sharing all those interesting thoughts. There's also a fourth bucket in my thing, which is I have fiat currency I use for spending, hard money I use for saving, and securities I use for investing. But I also have contribution, and contribution is where you get the things that make life worth living for. And this is where SBF kind of fooled us all, right? But the real satisfaction in life comes from contribution. And that's where you can spend money in a way that doesn't make any investment in sense, but it makes fulfillment sense. And you know, that's where the things that life are worth living for. What's the point in saving money forever if it doesn't give you any fulfillment? And that's where the contribution bucket comes in. But if you think about the philosophy and the economics, which I think you're touching upon, which is really interesting, is fiat currency is based upon Keynesian economics, which is increase the velocity by decreasing the value so people spend more, and spending at all cost is what drives economic growth. And when it leads to a recession or it leads to inflation, you create a business cycle where you get more and more people to spend by taking on debt. And then when the inflation comes along, you send them bankrupt by putting up the interest rate so they go bankrupt on their mortgage. And then you repeat the cycle because it cools it down. But you're always trying to increase the velocity of money. And when that system fails, the government spends. And Keynesian economics first taught that you're meant to repay on the way when the good times are up, but they never can because it's a Ponzi scheme. And so the supply always increases. And so people are in a race to spend, and when they can't spend because the system shafted them so much because they didn't buy securities or assets, they end up supplementing for debt. And depending on if you supplemented your debt to try and beat the system, i.e. mortgages, and investing in real estate and assets like the wealthy, or you used it to supplement expenditure, then you got on the wrong side of the debt cycle and wealth inequality grew and grew and grew. Then you got hard money. Hard money is Austrian economics. Austrian economics states that you long term through lower time preference, you build wealth, and as you build wealth, you spend more. And that's certainly been my experience. I spend a lower percentage of my wealth, but I spend a lot more in real terms. And so a wealth effect is the opposite, which is savings. And most people, because savings doesn't exist, because there is no hard money other than gold, and now Bitcoin came along, you have to basically make your investment your savings account. So everyone invests in the stock market, the bond market, and real estate as their savings account. But really, securities are meant to be where you take some of your wealth and you make a percentage of it so that you can get wealthier. And so because there is no savings account, people find themselves over speculating to beat inflation because we took savings and hard money out of the equation. Put hard money in the equation, and then you can do riskier things with your securities, which you're defining as tokens and DAOs. I consider them equity, debt, yield, tokens, various other things, various other instruments and real estate. But then that becomes your investment portfolio. And this is where, hard money plays its role. So thank you very much. It's an interesting conversation.
Thanks,
But yeah,
Kamki.
sorry, one more thing I do want to say on that, the SBF side. So here's one thing I'd like to reevaluate. And firstly, I do know people that have made incredible wealth trading and then became investors, but I know way more people that did well investing and then just continued on that path, because I think trading is really hard. and only 10%, when I was a market maker, less than 10% made money at the expense of the 90% of insiders. So if you want to be a trader, you have to be an insider to do well, and then it's illegal, and then you have all the SBFs and all that stuff. So trading rewards the insiders at the expense of the retail, and the retail always blow up gambling. 10% make, 90% lose, and so the great equalizer in this world is a 10-year plan of investing versus a 1-year plan of trading and then trying to become an investor, because you end up in a degen mindset once you make your money trading. And so that's the difference between Eric Voorhees and SBF. Eric Voorhees was a Bitcoiner that invested his wealth through Austrian economics and hard money and created enterprises through his investment that did well. Whereas SBF made his money through trading and then ended up building a degen shop that blew up 5 million people's wealth. And that's the whole concept of the psychology of investing versus trading.
Thanks for that, Comic Q. Now we have Alexander.
Hi guys, I hope you can hear me. Over here in Europe, it's I don't want to say early, but it's definitely not late. So Simon, you have a lot of good knowledge, and I understand you educate yourself in more than 20 years. Again, I do this since 2017. I also know Bretton Woods, I also know all this stuff. So here's my question. We see that not only Celsius, also FTX and so on, they all had the same model with their token. The SAC never called it a security. I think when you come up with your consolidated plan, a plan that only Bitcoin and Ether should be actually a commodity, I don't know how this works for stablecoins, but we definitely can agree that it should be for these tokens like FTX or Celsius, where you have a centralized player. The SEC never came around with this. When I look at your page, and I was investor in the A round, I think, not in the B round. Until now, I mean, I know what it takes to grow wealth, how you describe that. I do not want to exit the network. Never mind, I never saw anything currently that you even said you invested this. You tell me how much should it be worth from a fiat perspective. I never even could touch the money, or could touch this dollar. What you say? But what I wanted to ask is actually, I mean, again, they never made a ruling. What is a security? What is just a token? And you should not have a dollar pair against it and all that stuff. Because also with your plan, Simon, I have to trust you. I want to have a plan. I mean, Bitcoin came around, right? Again, that we don't need all this shit, because in 2008, we saw even what it's worth having all these security laws. We still went into a depression, or we still had a major blow up triggered by America. And even we had all these rules. Okay, so that tells me with Bitcoin, actually, we had an explosion in creativity in all that stuff, because I don't know, blockchain really makes it easier. It's peer to peer, right? But the question again is, even when I go with your plan, what will be your steps that I have my private key? Because you're totally right. This is how we should build up wealth. But I think a lot of people did that dollar cost averaging stuff. Today they look at their account and everything is gone because they don't have the private key, and everybody's freaking out. Where is actually Mr. Sam Bankman-Fried? What did he do to this exchange? How can he still have so much control? So how come that it's not the same with you in 5 years? Because let me get this just straight. I totally agree with you that it's about hard money, gold and Bitcoin. I mean, what the Bitcoin guys do not get, I cannot touch Bitcoin. I don't have a problem with this. But at least when we have something, when we have sound money like Bitcoin, it's not worth anything when I cannot move it. You get this, right? At least when I have gold, I can go down to my basement and say, oh, this great gold. People after 5 or 6 years do not even have this. So what is it worth to have sound money, which is really sound because nobody can create more of it, and we trust someone, and at the end, when it comes to it, nobody can do anything, because again, if I cannot move my coin, let's say whoever I believe in, it has no value.
Yeah, great points. Thank you for bringing those up. So I gave you the first part, like, which is figuring out your balance sheet and your cash flow and your financial plan, which is what we would normally do with our investors. Then I gave you the second bit, which is the tools. So how to think about spending, saving, and investing. and contribution. The final part of that is risk management. And one of the risks, we have like 10 risks that we go through. So in our wealth management program, we had like Andreas come along and set up the whole private key. And then we had, because the savings that I have are diversified across, firstly, none of them are in exchanges. I would never save in an exchange. The only reason to have money on an exchange is to trade. And that's a quick activity, unless you're a regular trader, and that's like your job as a trader, or it's a part of your investment account. But remember, your investment account can always blow up, so you need to diversify across exchanges, or only use them when you need to use them. My savings are diversified in two ways: one where I own the private key, and one where it's with a regulated custodian. I do that for a reason. The regulated custodian is to protect me from the scenario where someone either tries to ransom me, or I lose, or I get dementia. And therefore I can pass it on in an inheritance plan. The one where I own the key is to protect me from the custodian blowing up. And so you have risks with ownership as well. And most people don't do those steps. And so the game of, and I don't want to overwhelm, but the game of is you just get started. And it's just like the natural lessons of how to get started in this industry. Everybody starts, or most people start, by creating an account. Well, it used to be Coinbase, but now it's like Binance or something. So you'd create your account and you do the on and off ramps. Everybody needs to do it. And then most people stop there and leave their coins there. Or they put them in some yield product and then they end up blowing up the whole thing when it goes wrong. Okay. The step they didn't take is they need to go to the next stage, which is self-custody. So they need to learn how to download an app, or put it on their computer and transfer the funds from the centralized company to there. Then they need to take another step, or they could go from, for example, a Coinbase wallet to a Coinbase exchange to a Coinbase custody wallet. And then they could move it to self-custody on their phone. And then they could progress to, oh shit, my wealth is getting somewhere. It needs to go onto a hardware wallet. And then you can go really advanced as your wealth really grows to like multi-sig, non-hardware setups that you need to progress through that stage. And so this is where inheritable wealth, intergenerational wealth, is a long-term plan. And this is what you're discussing is the ecosystem. So I said, when we first got into this, I said, well, I want to build a platform where I can invest in all the companies that are going to build all of this stuff, so that my Bitcoin gets more valuable, and the ecosystem just keeps growing and growing and growing, and I can diversify across lots more and more solutions. And so Back to the Future, the solution that we're talking about is using the right mix of securities, custody, and self-custody. And that you need all of those. If you think that if you flip-flop from one extreme to the other, you're always exposed to one outcome. I know just as many people. I know somebody that lost like 25,000 Bitcoin because on a hardware wallet. So equally, you can't expose yourself to all of these one outcomes. If there's one message that you get, is that there's a lot of outcomes that can happen in the world, and true financial freedom comes when you have you're not working because you have to, you're working because you want to. That's the goal. So how do you get there? You diversify for all the different outcomes in the world. You don't just invest in one Bitcoin world. You also have to invest in a Bitcoin world, a change of empire, and the existing empire. And so I have a dollar portfolio that I know CBDCs are going to exist in America, and it's the existing empire. But I also know there's going to be a change in empire in my lifetime. So I have a gold portfolio. And I also have a portfolio that is the alternative, which is the vast majority of my wealth. And then I separate it between spending, savings, investing. And then I diversify across the different risks. There's about 10 different risks. And one of them is the custody side. There's also others. And I know it's complicated, but this is what we've always tried to create, a longer term plan, because you start simple. because if you try and do everything right in the beginning, you'll get overwhelmed with complexity. But you start simple and you progress as your wealth grows, and that's the beauty of hard money. Okay, thanks.
Jerry?
Hi there. Hi, Simon.
Hello.
It's been a while, actually. Thanks for having me on. Thanks for running this.
Jerry from Japan?
Yeah, we haven't spoke since, gosh, I don't know, 2017 or something like that. Probably some
How you doing, man?
Conference stuff like that. Yeah, pretty good. No, I'm just listening to your explanations and stuff, and I just, my question is, this shock has probably made a lot of people sort of wake up and sort of evaluate more rationally the fundamental basis of a lot of the business models in the space, which I think you've addressed quite well in the questions leading up to this point. When you were talking about Bank to the Future, though, I would like to get your opinion on. Well, let me phrase it this way. Let me rehash. When you were talking about your model of Bank to the Future, which is that you are mostly long-term holders of Bitcoin, you will basically keep Bitcoin as a store of wealth, store of value, and use that Bitcoin and use that to invest in other companies, which would presumably also do something that would generate wealth in Bitcoin. But the outcome being that you are long-term profitable by the price of Bitcoin going up. And so I guess the implied, and if I'm wrong, then you can stop me at this point, because my question depends on this sort of assumption. The business model is entirely dependent on the price of Bitcoin going up as its primary source of rev or profit, I suppose.
No, yeah, we make profit in dollars, but the balance sheet grows by Bitcoin.
Right. So your profit in dollars wouldn't grow if the price of Bitcoin doesn't grow vis-a-vis dollars.
No, we make sure we got a profitable business, so we can cover all of our operational overhead, and then you have a Bitcoin income that comes in, and it's more than just Bitcoin, because obviously we invest in securities, so we get lots of other stuff as well. But that sits on the balance sheet as an asset not to be sold.
Okay.
And your balance sheet grows, which is the same as what I do as an individual.
Right. Okay. So then I guess it's like you're treating Bitcoin as more like an asset in an equity portfolio or something like that. It just happens that you're it's like as if you were accumulating Apple stock and Tesla.
It became our VC. It prevented us ever needing a VC. We've only done community funding through our platform and Bitcoin. We've never had to do anything else.
Yeah, that's the benefit, because I mean, yeah, I see that obviously is if you're investing in, if that's the medium by which you invest in other companies, then it doesn't require any traditional finance except for the initial injection of wealth to get that Bitcoin fund started. But so maybe I'd just like your opinion. I'll the question is still somewhat relevant, I think. So my question is actually, so in this sort of model, because it is not a traditional model, and I think people should think about
it's a Bitcoin standard.
Sorry?
It's a company Bitcoin standard, an individual Bitcoin standard that we can learn from understanding a country Bitcoin standard.
Yeah, exactly. Yeah, so I guess you could extend this question to like, how does the Bitcoin standard get established? And is it viable? Like, what are the next steps? What is okay, so let me just ask the question. So if this is the way of one way of doing it, and if this way of doing it is long-term viable, so it's not just a short-term thing. It's not just working because the Bitcoin price has been going up. I mean, I guess that's to be tested, because if the Bitcoin price starts going down, over the course of 5 years or so, does this model still work? I don't know, because we haven't seen that in real life yet. But assuming that this is a long-term viable, my question is, does it matter? Does the companies that you invest in, vis-a-vis companies that are doing businesses in Bitcoin and also earning in Bitcoin, and taking in US dollars for Bitcoin, and versus companies that are just Bitcoin, crypto in crypto. So does that sort of drive your decision on the companies that you invest in? And the reason I'm asking for is this: like, this business model seems to work because you're the source of funds, but it kind of seems to me to build an
No,
economy.
we're not. Let me explain. So,
Okay.
Bank to the Future pulls together investors. We allow people to invest in securities. So, if we want to invest in something, we require a lead investor in a funding round, and then we allow other people to invest as little as $1,000 into the securities and build a long-term diversified portfolio. We get a carry on that. So when Coinbase goes public, for example, we received the 5% fee for that carry. So that's our business model. We allow people to invest in securities. Now, the companies that we support is we have a mission, and the mission is that if you are a company building in the fintech space and Bitcoin crypto fintech, and you secure a lead investor that goes through the DD process, then we allow our investors to co-invest with you. And we have an investment committee that decides what gets on, and then a DD process based upon the lead investor doing the DD and then providing the DD to us. So we're not making bets, we're making diversification. So if someone wants to build a securities portfolio in the industry, then, and we also have secondary markets when people want to sell them to other investors as well.
Okay, thanks for your questions. Next we have Prashant.
Yeah. Hi, everyone. So actually, I think one of the key important things which has to be highlighted here is that how we treat these assets in our balance sheet, because crypto companies has to comply with a lot of laws, and these laws vary geographically. Like, for example, in India, I think Indians are really not talking about much how much money they have lost with the FTX disaster. But the structuring which has been done is so complex that we really have no regulatory authority and body to whom we can report to, right? I think that is one thing. So really the crypto community should have a global forum which works on the standardization of laws, practices, and treatment of balance treatment of these balances on the balance sheet, like in a very standardized way. I think Simon and there are a lot of experts here who should actually talk about that. And going forward, I feel that would lay a very important foundation on how companies could be more compliant, could be more transparent, and things like that. Because I have been running exchanges, other enterprise blockchain businesses, and things like that. The second thing which I would also like to highlight is that I have been working on the CBDC project in India, right? And I would request to all the listeners not to post these details which I'm about to share now, because that's like something very critical, right? So
All right, we don't want to promote any particular projects, but
yeah.
So let me answer. So firstly, I really like that point. You have actually touched upon the key issue that no one talks about, and it's actually accounting. Accounting is the issue of all issues in crypto, and it's actually the most boring subject that no one wants to talk about, but the cause of all of these problems. Crypto accounting is complex, and you kind of, I don't want to go too geeky, but you have like gap accounting, which allows you to mark down but not mark up, and that's being reformed at the moment. And so that's where you have like the Michael Saylor MicroStrategy model, and it causes an inaccurate reflection of the business that then leads to people buying and selling their stock based upon not being able to read the accounting data. Then you have IFRS, like International Financial Reporting Standards, where you are allowed to mark it up. And that's when you get the Celsius and FTX model, where it feels overvalued because it doesn't factor in liquidity. Then you have the magic of fractional reserve banking, which is essentially where when you take out a loan, the bank simultaneously creates an asset and a liability and therefore it allows them to create money, which is where they have all of the stress tests and VARs and everything that happens in the banking model. And so somewhere between all those, there's this new Bitcoin crypto accounting standard that will need to discount based upon liquidity and determine whether these things are securities. Do they sit as equity on the balance sheet, or do they sit as revenue? You are 100% right, but if I created a space talking about these subjects, everyone would be asleep and bored. But it is actually the key to the issue. So thank you very much for bringing it up.
Thank you for your question. Simon, we have a DM question. Do you want to take that one?
Okay, go for it.
Yeah, someone was asking about the crypto.com CEO saying that they accidentally sent 400 million ETH to the wrong wallet address, and they just wanted you to speak about that.
Yeah, I'm sorry to say this because it's going to be bad for our industry, but I've got to think about the individual rather than the industry right now. You should absolutely not have any money on any lending platform right now, and you should be withdrawing it immediately and not listening to me. So if you have money on any of these platforms, there is systemic risk in the industry. They're selling illegal securities. There's cease and desist orders after all of these platforms. And they rely upon everybody else not withdrawing because they didn't sell it as a security and they sold it as a deposit, and therefore everyone thinks that they have their money and don't know that it's at risk. So all of them will go through the same destiny, unfortunately. So anyone that thinks that there's a good platform to be, there isn't right now. And so the same with exchanges. You shouldn't be storing on exchanges. And we've got to shake out. Why? Because FTX was connected to all of these platforms. Like, many of them probably have exposure. There's many hedge funds that have exposure. There's many companies right now that are sat around on a nightmare weekend trying to figure out what they're going to be communicating to their investors in the weeks ahead, and their communities. So at the moment, you should not be in any of these platforms. You should be having it as, either they're segregated in custody, or you're holding it in self-custody, or you know that it's an investment and you're willing for the whole thing to go because it's locked up and it was sold in a correct way, where it was disclosed as either a security or a fixed term without instant liquidity. Anything that has instant liquidity right now is a problem. If they're putting their money at risk, they're going to have they're either illiquid or insolvent at some stage as people withdraw. And so, do you want to be first or last? Well, if you're last, you'll be in Chapter 11. If you're first, then you will have it in self-custody, and then you can figure out what to do with it later. That's just where we are right now. So crypto.com, they sent out a tweet saying that they sent a bunch of ETH to Gate, and then came back with less ETH, and they were trying to do something with proof of reserves. I just sent out a tweet on it. I didn't go too deep into it, but there's some things going that are very concerning there. And so accidentally sending client funds to an exchange rather than cold storage seems like either you've got complete negligence in process, or you're doing something strange. And either way, now is not the time to be taking risk.
Right. Thanks for that. More Drake?
Well, hi, everybody. I know it's been a really crazy couple of days. Well, you know what they say, may you live in interesting times, and we are definitely all there. So, what's going to happen? We're going to have governments of the world collapse, and this is where we're going to want the cryptosphere to step in, because we're going to need that technology to bring some kind of control over the rampant corruption that is inherent with large governments. And that is exactly what crypto can do, beyond a shadow of a doubt. Now, all you people in the room getting ready to go ahead and mint more NFTs. You might as well start getting ready for that, because I suspect over the next week there's going to be a lot of people looking to get all their liquidity out of all the exchanges after what Elon said last night. And I was there and I heard it firsthand in the room. He came in and he was driving along his Tesla and he got rugged a bunch of times. And then he said, Doge to the moon. We all had a good laugh. And I opened up the chart and I watched it just go absolutely insane. The Doge charts, I was watching them and laughing my ass off. And then you talked a bit about the crypto sphere itself and what he thought was still going to be around at the end of it. And he said, yes, of course, the original is going to be around. And that includes a few of the major names. So, I mean, not everything's going to disappear, but you've got to realize that this is going to be a gutting event, and it's going to lead to, with the leverage involved, it's going to lead to the complete collapse of the North American stock markets and probably the entire world, in my opinion, is going to be shut down stock market wise and crypto wise by the end of the month at the very latest. Maybe by the end of this week. We'll see how fast it goes and how quickly all the breakers start going and how exactly they handle the situation. So it's going to be lit. It's going to be lit.
All right. Well, thanks for sharing that. Let me do a few comments on your analysis. Firstly, stock markets tend to only close during times of war. There's only one stock market that most stock markets recover, and the Japanese stock market was the one that never recovered from excessive over money printing. I do believe that you will get a central bank digital currency bailout within the next 10 years. And they won't crash the economy. They'll just take away your privacies and freedoms, and we'll move to a much more communist style and large government way of organizing, and a less capitalist way. And you're absolutely right that you do need an exit from the system in order to regulate the regulators. So centralized companies need regulations, and then you need regulators are also corrupt. So you need regulators of regulators, which is an exit from the system. So I think you transition to a CBDC versus Bitcoin, with a bunch of securities around it world. And you need DeFi in order to combat CeFi. And you need that symbiotic relationship in order to get that right mix between freedom and lack of freedom. And so just as with my fiat currency in a bank, I don't expect access to it. I don't expect to be able to spend it easily, and I don't expect it to go up in value. I just know that it's useful for paying expenses, and that's about it. So I want as minimum amount of that plus a buffer to never be in a cash squeeze with my personal expenses. But the rest of it, I want it in hard money, and invested in freedom, and prepared for all outcomes and hedged for other outcomes, so that whatever happens, you could be right, all of that could happen, but I want to make sure that I'm in a financial position where whatever happens, I may not get the highest return than if I got it 100% right and 100% on one outcome, but I can relax, and that's what I want for everybody. And I do believe that the transition from the markets that we're in right now to a shift in the world reserve currency to a CBDC standard and Bitcoin voluntary opt-in standard for certain countries, individuals, and companies is probably a decade-long process. So if you take where you are right now and put together a 10-year plan, I think everybody can be in a position where they can have they can take financial anxiety out of their life, as long as they can hold on to their income, and then they can put together a 10-year plan. I think everyone can make that transition. I don't see the extreme, it's too late type of measure. Thank you.
Thanks for that. Rad Ed.
Hey, thanks for having me. So just a quick question, kind of leaning towards more of like a future take, and a lot of users, I think even now you can kind of see without, mentioning a specific project in DeFi, is the volume is definitely increasing as people are starting to kind of move over there already. But just kind of thinking about in the future and like the ease of use for the average user, what would you think like as a time horizon for people to kind of start to get a grip on like, no longer using centralized authorities and things like that? Because, I come from the 2017 era of, crypto trading and living through BitConnect and learning the hard way about, not your keys, not your crypto. But I definitely see the trend already happening with DeFi, but I'm kind of wondering about the time horizon for like an average user.
Yeah, so the answer I give to that is firstly, I don't see everyone transitioning to one or the other. I think they both keep each other honest. So I think DeFi can get very dishonest if it doesn't have traditional finance, and you need on ramps and off ramps. And if you're asking the government to not care about tax collection and surveillance and control, then you're definitely fighting a losing trend. So they will always have that world, and it's epitomized in CBDC as the technology. But at the same, you just need both, and I believe in a coexistence. Like I also believe that soft money is good for spending and hard money is good for saving. And if you take out one, I don't believe in this hyper Bitcoinization. I believe that you need competition always wins. To give the best outcome, and competing countries as well. So in terms of user experience, I say that as an entrepreneur's question. So when I first got involved in Bitcoin, the user experience sucked 1,000,000 times worse than it does right now. And so I just wanted to invest in as many companies that could improve that user experience. And so the answer to when does the user experience is how long does free market is this free market allowed to persist? Then the user experience will keep getting better, because entrepreneurs will come up with ideas and investors will invest in those ideas. And as long as you have hard money, I believe you have the opportunity for people to create wealth effects and invest in those entrepreneurs. And you'll have those that are not suited to the risk of entrepreneurs that will join teams and companies that will build those user experience, and the risk takers that are willing to take that level of risk will build businesses and then they improve user experience. So I believe in Austrian free market economics based upon hard money, and I think that's what we're building here to combat the larger government CBDC world that we're all transitioning to with mass surveillance and control.
Right. Moon person?
I actually have two questions, but I'd be grateful even if you could answer my first one. With OTCs like Grayscale, they've got some, Bitcoin Trust, Ethereum, and then they've got their alt cap. I feel like those are going to be a lot more well managed, and I feel like they're going to be backed by real money. Where do you see them moving out of this? Do you see the SEC giving them approval to be traded? And then also with like Valkyrie, how do you see them being the one, publicly traded? Do you think that they knew what was going on behind the scenes and this is their way to possibly really push into XLM and XRP and have a central bank digital currency that we know will work?
Firstly, the GBTC is an awful product, and also played into the 3AC and the yield platforms, where many of them were playing yield, arbitraging the trust versus the spot price. and when those trends reverse, I mean, what are we at, like a ridiculous discount right now or whatever it may be? It's such an awful product, and it also, because the ETF was never approved, which is a vastly superior product, then we actually had that premium persisting, and when it reversed, it blew up 3AC and many of the crypto lenders as one of their trades as well. So I think regulators, particularly the US regulator and the SEC, has completely failed investors for investor protections there by allowing a completely inferior product to be indirectly exposed to retail investors, because the crypto lending platforms were trading that orb and lending to the hedge funds that were playing that orb. So even though it was only open to accredited, retail were exposed in the end. So it's a complete failure by the SEC for, I think, very political reasons, because they didn't want the Bitcoin ETF to be to persist. So if they had just let it on ages ago, they've played a role in very much hurting consumers. It's been an epic failure for that. So they should have get it on. But also remember, the ETF should only be an on-ramp, and eventually it should be moving to private keys as well. Thank you.
With that, I asked that question because I know that Barry Silbert shorted Dogecoin through FTX right when Dogecoin dropped after Elon Musk was on Saturday Night Live. And it feels like he's got an investment in Coinbase and in Genesis. So a lot of things that are happening are connected there. And Leah Walda Valkyrie didn't say the exact words you said, but she also said the same thing about the theory of trust. And so where I would like to go with this, because it feels kind of good to know that that's how you feel, someone who's been following Bitcoin for so long, because I just got into cryptos in 2020. Is there a possibility in the next 3 years that layer twos like Loopring or Immutable X or any product like that could allow us to have a more peer-to-peer system, and we could create NFTs and innovations as people?
My key with that is I diversify. So with my predictions on which companies will fail and succeed, I've done well, but I've invested in failures. And so what I try and do is I try and say, well, what are all the different parts of the ecosystem, and how can I invest in them all and be diversified? And that's my investment side. And so rather than going down to the granular of that, I'll look at, if that's your thesis, how do you get exposure to that thesis? And so to me, I don't try and get that specific. I just diversify really widely. So if this industry succeeds, then my portfolio will go with it. And so I wouldn't go that specific into whether those projects will succeed or not. Is layer 2 and peer-to-peer inevitable? Yeah, of course. We've been building it we've been trying to build it for many years, and we'll continue to build. The building won't stop, and the technology can only get better and better.
Right. Next we have Fresh. Fresh, are you there? Fresh refrigeration. Okay, I'm gonna move
Yeah,
on.
yeah,
Oh,
yeah,
go ahead.
yeah,
Sorry.
yeah. Hello, everyone. Hello, everyone. Yeah, Simon, on the beginning of this Celsius thing, you told us that in terms of trade, anybody can put crazy stuff there, like I'm allowed to do this, I'm allowed to do that, I'm allowed to come to your house or whatever, but that doesn't necessarily mean that's legal. Well, it looks like his honor Judge Glenn Martin is looking at Celsius and the earn bucket, and from what you said, it looks like he's inclined to make a ruling that the coins are the property of the estate. Well, how can that decision be made if we know Celsius did not have the proper licenses to be a bank or fractional securities investment? How can that decision be made if the proper licenses were not in place to be able to do such a thing? And
Yeah, let me answer
where
that.
does that? Yeah, okay.
So that's a legal determination, and law is determined in court through case law. But it makes no difference as creditors, because the only difference it would make is whether they determine whether custody own their funds because it was not really managed correctly versus what it said in the terms and conditions. But it makes no difference because the coins don't exist. So even if they determined that was ours, the only consequence it would have is a tax consequence. And it may be that in the plan, that you want Celsius to own those funds so that they can, if they're going to be rebalanced or traded, the tax event may be on Celsius's back rather than your back. So if it made a difference, if the money was there and determining that the funds were yours and they had the funds, then you would be able to get the funds. But there's a haircut. They've lost our funds. They invested our funds, and they can't return them. They invested in illiquid assets with our liquid assets. They said that it was ours, and they illegally invested it in securities, or sold and didn't sell it as a security. So, you're probably entitled to about half of it back. And it doesn't really matter apart from a tax side if it's theirs or yours, really, because it would only matter if they had the money.
Right. Thanks for that. Simon, how would this relate to FTX? What's happening with Celsius?
So FTX is really, it's just the criminality of it. So if you can prove that it's crime, then you might increase, well, as it is, but you really increase the chances of it being classified as Chapter 7 liquidation, which is a bad outcome for creditors. If it's more questionable and more debatable, then you might get through the Chapter 11 bidding process, in which case you could have a reorg where you get, not the company can't reorg because of all the things it's done, but you could have a bidder that could then give you what funds are left and a security. And so we'd look to support any of those processes in any way we can, because then you get a long-term investment in the industry, which was the same bet that Alameda made, essentially. If you get to benefit from their bets, rather than those just being liquidated and crashing the market, you could see whether their bets were any good, and you could own a security that gives you exposure to it if they allow you to do it, if you can get through the Chapter 11 auction and bidding process. So really, sometimes our initial knee-jerk reaction gives us the worst outcome.
Thanks for that. David?
Hey, what's up, guys? Seeing a lot of FUD about crypto.com right now. Most of it seems completely unwarranted. I saw what you were talking about earlier with the what was it 320,000 ETH sent to Gate.io. I did want to correct something you said, though. You said they did not get back all of the money. They did. It was just sent in a different transaction and it's in a different wallet. So they did get back the 320,000 ETH. So they did get it all back. But that was the only one little thing. So that there's everybody was saying there was like $60 million missing because there's like thousands of ETH missing, but it's in a different wallet. It did get sent back. So that there's that one thing. But like, other than that, why would, like, what is there really to worry about at crypto.com? If they do have the one-to-one user funds, is there actually anything to worry about? It kind of doesn't seem like there is.
Yeah. So firstly, thank you very much for correcting that. I can't fact check it, but that's more information for people to fact check. So that really appreciate that. And the second thing is I completely disagree that there's FUD. the reality of the market is that crypto lending means that they have to put your money at risk. And so by putting your money at risk, they're generating that yield, which is a security. And they are all receiving cease and desist orders from regulators for illegally selling securities. And so therefore, saying that there's one-to-one implies that it's custody. It's not custody, it's funds at risk. So as people are withdrawing, they eventually hit a liquidity issue, and they would have to suspend withdrawals if people are withdrawing, because they absolutely should be risk off at the moment. And so if you are the last person standing, you're going to be in chapter 11 going through a reorg with your fund stuck. If you take your money off, then you can figure out what's going to happen. But the only way they're able to pay you yield is because they're putting the funds at risk, and they didn't disclose that risk because they didn't sell it in compliance with securities laws. That's not FUD, that's reality.
I agree. I agree with getting your money off of an exchange regardless. It shouldn't be there. You should hold in your wallet, and if you need to like sell it, they're off ramp or on ramp, then use it. I agree with that. Now my question, I guess, is all right, in crypto.com, I guess they have that earn section. Would those be the customers that would be at risk for that because they're in that earn section? Or
Firstly,
is
I'm not
everybody?
I'm not a user, so I don't know whether they segregate their custody correctly and then they sell earn as a security. My guess, if they're like any other platform, they don't. And everything I know about crypto.com and their background implies to me that they don't respect regulations and do things properly. So I would be highly skeptical if they were selling earn as a security. And they were actually disclosing the risks, or they were fully segregating their custody service. I don't know. I haven't looked into it, but my guess is it's the same as everyone else.
Yeah, for the they do disclose the risks. You have to check like 4 stupid boxes and then like another one after that. There's a bunch of crap you have to read. But
So in that
as
case,
for the
if you've invested
segregation
in
part, I
if you've
agree.
invested in a security, then you know that you can't take it out because you can't have instant withdrawals on that. You could only sell it as a security. And if you sell it as a security, it's just the price that you get. Or it's an illiquid security, in which case it can go to zero and you can't withdraw anyway. But the custody, you should be able to withdraw because the custody is held in your name, and those should be separated and segregated.
Thanks for
Agreed.
that. Thank you for your question, Hourglass.
Yeah, just thinking about the main situation with this problem that SPX has created. I think the damage has been done, and I'm sort of thinking about the aftermath of what's going to happen at this point with the shakeup in the crypto space. I'm not sure if what kind of regulations are actually going to proceed from this event that are going to directly advocate this from this event. I'm not really sure what that's going to look like, but I think that it's very apparent that at this point, I don't think that everything has unraveled. I think that there's a lot of dominoes still to be attacked from what FTX and the FTT token have sort of created, along with everyone that was invested in them. So, I think this is going to be an everlasting event for a little while, but I want to point out that I do, like how the Twitter space is kind of looking at this whole thing. I think that, yeah, I've mentioned in another space that this is I'm learning so much from just Twitter and Twitter Spaces than any other sort of major platform. So it's a very good place to be gathering intel. And,
yeah, isn't that incredible?
Yeah.
So the Twitter Spaces has been just a real breath of fresh air for people that are just suffering from so much uncertainty, and then just crowdsourcing this collective intelligence of people. It was so awesome being on
Yeah,
the Elon Musk one yesterday. I was on that for a long time. It was really cool. That's had over I think almost 300,000 views now.
Thanks, Hourglass. Did you have a question, Hourglass?
Yeah, in terms of regulations, I'll comment on it. I think the first thing they're going to do is enforce the existing regulations that already exist. Everybody gets confused with this. The regulation that wasn't clear is, what is a cryptocurrency, right? Is it a commodity, security, an asset, property? And each four-letter agency determined that. But the regulations of centralized company already all exists. So they just weren't following it. The SEC was shouting out. They were sending out cease and desist orders. You're offering illegal securities. The lending platform said you need to have lending licenses in order to offer these collateralized loans. And the custody services were all receiving letters saying, you know, that there's regulated custody and you need trust custodians or money transmitters. And also, if you're a bank, you need to hold this on your liability and you need to meet the Basel requirements. So there is no new regulations. It's just there was too many companies that weren't complying with those regulations, and then the companies that were complying with them got left behind because they couldn't compete and offer the user experience that everybody wanted in order to engage in these services without disclosures, without any of the practices, because the industry wanted to make money fast in a year rather than being long-term investors. So we're all a part of this. And why are we a part of that? Because we've been built and were born into a Ponzi scheme called fiat currency, where we were all shafted by the system, whereby we had to make massive speculation in order to beat the money printing that governments created. And therefore, it drove us into a mindset of scarcity, where we have to make money as fast as possible because we have to try and keep up with the rat race based upon a Ponzi scheme of banks creating money every time they issue a loan that was then repackaged into the investment bank. And then the investment bank decided to package them up into mortgages and securities that were then sold to our pension. And then our pension created a product called a credit default swap based upon a mortgage-backed security of slicing and dicing it, and then creating derivatives that became bigger than the entire markets of the world, that was over leveraged many thousand times over in a regulated Ponzi scheme, whereby we created another Ponzi scheme called FDIC that only insures about 1% of those deposits, that leverages up to the off-balance sheet assets called the investment bank, that then sells it to our pension that contributes our money that we contribute every month. And then they invest it into stocks and bonds. And we're expected not to try and speculate on something like hard money in order to try and get out of the rat race and get ahead of the system. So this is why you need this two-tiered system, and we can't go one extreme to the other. And in 2008, as a force, a speculative attack on the system was created called Bitcoin that said the banks are on the brink of disaster and mine the first Genesis block. And this social experiment that was never meant to succeed succeeded. And all these companies then created the banking system using Bitcoin, where they got you to deposit their Bitcoin at their bank called an exchange. And then you gave up ownership of that money, and then they started to spend it on investing. And then they started to create more, they got hacked, and therefore there was more Bitcoins that exist on their balance sheet. And then you have to stress test them every year through proof of keys, which was an event on February every year that we never started to uphold because more and more people join the industry. And then every year people learn the lessons, and we go back and we realize that we've actually got money we can own, money we can spend, money that has a fixed supply, and the ability to exit the system, get ahead of it with Austrian economics and digital hard sound money, while the government scrambled to fix the system with central bank digital currencies based upon the demands of people asking for governments to be bigger and bigger and bigger because they're so deep in debt and they're so enslaved by the system because of this fiat Ponzi scheme. And then some countries going to come along and say, hey, I'm going to use Bitcoin for our country because we were shafted by the IMF. And I don't need to borrow from the American agenda IMF that then makes predatory economic hitman loans. And I don't need to borrow from China through the Belt and Road Initiative and become a debt slave. We can actually make a third choice, and we can build Bitcoin-backed bonds. And we can use Bitcoin as a percentage of our country's future. and we can actually benefit from the system as these empires change, and more money is spent on preserving the existing empires through funding bombs and nuclear warfare. And instead, we can actually choose a third choice, and at some point that changes, and we get to involve in the next 100-year cycle and build something better for our children and our grandchildren.
100%. Mark?
Hello,
Hello.
how is everyone doing?
Awesome.
I'm good. I don't have much to say right now, but I just want to know more about the project because I
It's not
just
really. It's not really a. Yeah, it's not really me pitching a project or anything. This is just us trying to. I keep deviating because I'm an excitable character when someone talks finance, and I'm a complete geek, and it takes me on a tangent. But we were meant to. The project is FTX, and everybody's wrecked. And so what happens next is it's entered into a Chapter 11 process. An unsecured creditor committee is going to be formed. And that unsecured creditor committee is anybody that is owed money. They can apply. There's about 5 million people that I believe has owed money, depending on the withdrawals. We'll find out very soon. And then you're going to engage in this process. And sorry to break the bad news for you, but if you put all of your money on FTX, or your business depends upon that money, I think it's more institutional and more traders than Celsius, where people were putting their life savings, because FTX was represented as in a different way, more speculators, traders, and companies that were building in the ecosystem and institutions. At Celsius, it was represented to retirement plans and the everyday person that had money at a bank. So I think we're going to get a slightly different audience in that. But we're going to be, if those funds are needed, expect not to receive anything for the next 2 years. Plan around that. It could be longer, it could be less, but don't expect to receive these funds. If you've got funds in your business, expect that you're going to have to be speaking to your investors and disclosing that those are probably a write-off. Looking at the balance sheet in the worst case scenario, it looks like you might be able to get 10% of your funds back at this stage. We don't know enough to make that determination until they release the information. But there is a bunch of
I think you
illiquid
meant to
assets.
say best case scenario.
Best case, sorry. Thank you. Best case scenario. Well, it's not best. It could be better. We're just going on what information we have right now.
Sorry.
Yeah, and then we have securities. They invested in a bunch of securities, and hopefully those will have some value. And then it will go through a process of either bidding, auctioning off those assets for the benefit of creditors, or the government's going to come down hard, sell everything, liquidate everything, and that's going to cause probably the next cascading downside for our market. Sorry to give you the really bad news, but we just got to be prepared for that.
And the government, as we all know, since the 2008 debacle that happened with the housing markets, they changed it so that there are no more bail-ins or bailouts. There's only bail-ins, which that means all the people, the regular people, all the regular investors, they are going to lose everything, and there's no recourse.
Actually, I prefer bail-in to bail-out, because bail-out is the government prints up the money and creates hyperinflation in order to give you the illusion that everything's okay. So they give you money that's significantly devalued. But with the bail-in, they give you equity in the company, which allows you to become a long-term hodler without the unsustainable nature of diluting the deposit that you got destroyed from in the beginning. So personally, I think bail-in is a more sustainable free market solution, and bail-out is just rehypothecating a Ponzi scheme that led to the situation we're in today.
Hey, Matt, how you doing? Maddie, are you there? Maddie Greenspan, can you unmute your mic?
Sorry, I didn't realize I requested. Apologize for that. I love Simon Dixon. He's an awesome fellow, and I'm just listening. Everything you say is correct, sir.
Well, not everything. I do get things wrong. I say stupid things sometimes.
Well, everything you've said in the last 10 minutes was spot on, man.
Thank you.
Thanks for coming up, even though you didn't request. Mark?
Hey, Mary, should we make this the last three?
Absolutely. Mark, can you unmute your mic? Okay, I'm going to move on.
I am listening to everything I'm here.
Okay. Hold on just 1 second. They're connecting. I think he's having connection problems. Ben, are you there?
Yeah, how you going? Yeah, I just wanted to back that last comment up and thank Simon. Like, I've never heard anyone just put it like that. And yeah, mate, that was just fantastic. And yeah, I've never heard anyone run through the whole process of the system like that. And yeah, thanks very much.
All right, thanks, Ben. It's normally someone inspires a question that makes me go on a rant, and then I don't understand what I'm saying, and it comes from nature of just the sheer craziness of the system. So thank you.
Thank you. Christian?
Hey, Simon. I think I'm pretty aligned with all the stuff you've been saying earlier. There's just one question I had. You mentioned earlier about the housing bubble, and I was wondering why do you think that is a bubble? Because from my perspective, I think it's the massive inflation of the monetary mass that has caused the rising prices rather than actually being a bubble. And I'm talking about like the last like 10 years or more, not really about the last couple of years, which compared to the rising salaries, the housing was really high.
So real estate is banks' favorite mechanism for creating money. So if you have a license to create money every time you issue a loan, you like to lend it based upon an asset that is fairly, well, real estate isn't too easy, but fairly easy to liquidate and can't run away. And so the entire banking system, about 40% of all loans are based upon the mortgage market. And then obviously you've got the off-balance sheet stuff, like the mortgage-backed securities and Fannie Mae and Freddie Mac and the collateralized debt obligations and credit default swaps. They didn't shrink after the financial crisis; they got bigger. So they just solved the problem with the cause of the problem and increased the debt and rehypothecated the market even further. And then the government, because no one can afford their house, because a house is meant to be lived in, not a savings account. And so because people treat it as a replacement for hard money, they end up using it as a savings account and their primary source of trying to beat the system. Because fiat currency goes down in value, they end up working harder and harder throughout their life. And then in order to be a good citizen to the fiat currency system, you have to borrow money to create new money. Banks like to they like to use real estate as the mechanism for creating money, because if you default on your mortgage when things get too hard, when the interest rates go up, the government needs you to go bankrupt. And so in order to go bankrupt, they need to repossess your property to calm down the prices and make you poorer and bankrupt. That's the business cycle. So they put up interest rates to do that. But then they get scared, and then so the government steps in and prints up some more money, because they effectively said free markets don't exist anymore. Every time the stock market cracks or the real estate market cracks, we need to prop up the market, not recognizing that actually it's creating the biggest wealth inequality in the world, because now people can't afford to live in their house. And so the price of their house relative to their income is just absurd. Like there's no reason whatsoever, and it's not good for society for houses to be savings accounts. But it's just a function of the money creation system by banks. And so if you get a deleveraging of the system by a central bank digital currency, then you're removing banks' ability to create money and you're replacing it with a CBDC. That's a deleverage of all debt-based products, which is real estate. Real estate is the primary mechanism of pumping the Ponzi scheme. And so, yeah, and at the moment, people think that it's a bad thing. Like, if you speak to real people want to buy their house. They don't want to rent in their house, and they can't afford to buy it. So why should correcting be a bad thing? Well, it's a bad thing to those people that tried to beat the Ponzi scheme by buying the asset. And it's all a function of not having hard money and a place to, say, store your value. So you use your real estate instead. So in the end, real estate prices are not a function. They are partly a function of population and demand and population growth, but they're more about government subsidies and programs for allowing people to become first-time buyers and banks' willingness to lend. And affordability. So once it becomes completely unaffordable, you have a subprime, and then they try and pump up the system again and rehypothecate. So it's just a yeah. That's real estate is that.
All right, Simon.
But in
We have the
terms
last
of
question. We have the last question from Christian Dan, and I want to thank everybody for being patient. I'm sorry for those that I didn't get to, but the last question is Christian.
can I follow on?
Hey, Christian.
In terms of it being a bubble, if the salary rises in line with the pricing, in line with the housing price, does that still mean it's a bubble?
Maybe we're just using a slightly different word for a similar thing, and maybe you got a different definition of a bubble. But I'm just talking about a market that is 100% dependent upon banks creating more and more money and increasing the money supply. So you always have to increase the money supply in order for banks to create more money, in order to issue more mortgages, in order to rehypothecate a scheme where there's more debt than money. So if you have more debt than money and it's backed by this asset, it's a Ponzi scheme, and that's what I'm classifying as a bubble. Maybe you're talking about a bubble being something that has no, I think it's the wrong word. You're talking about a bubble being something that has no real value, that's just being pumped up on price. Obviously, it does have real value. It's just out of whack.
Yeah, it makes sense. Yeah.
Okay, thanks for correcting that. All right, Mary, should we wrap up?
Thanks for the.
Yep, that was the last question.
Was that Christian? Okay, nice. Okay.
Thanks for the thorough
all right.
explanation.
No, pleasure. Okay, all right. Look, thanks everybody. So, look, back to the subject. FTX's balance sheet. If you jumped in halfway through, I gave the best explanation I could come up with. So do go back and watch the recording. Go back to the beginning, and I think it's going to save you a lot of time and a lot of unpacking, just to understand where it goes next. It covers why certain regulations exist and how we get confused by our desire to have Bitcoin as unregulated and DeFi as unregulated versus centralized companies. It also helps you understand how in history we've dealt with these situations and how it relates to today. And it also gives some ideas on what goes next. But I do want to leave you with some ideas on what happens next. So I've been through many of these before, and each time they get more dramatical and bigger, but they are the same thing. And the same thing is that you end up in a cycle, and Bitcoin has historically been through 4 to 5 year cycles around halving. And approximately 2 years before halving, which is where we are now, you normally come off a bubble. And that bubble is normally created by some new innovation that gets a lot of new investors into the market. So originally it was the gambling market and the dark web. that got lots of new people in, and then that led to an exchange. It creates a bot-led Ponzi, a bot-led pump, which was Mt. Gox. And then that practice unwinds and an exchange blows up. So that was the original one, Mt. Gox. Once it unwinds, you get a massive correction in price, and then eventually it goes to a capitulation stage where everyone's out, everyone thinks that Bitcoin's dead, and you get those that were just in it for the money, they all leave, and you're left with just the builders. And then the builders, they continually engage, the numbers go down, the media continually says how we're dead, how it's over, and regulators jump in and do a regulatory crackdown. And then what happens is those regulations come through, and then we enter into a sideways market into the next wave. And then someone comes along and new people say, oh, I've got a way of circumventing those laws. And they create a new system. And you get this cat and mouse between decentralization and centralization. And something in the decentralization area sticks and becomes genuinely innovative, but most of it just becomes circumventing regulations. And when you see those opportunities and price increases, you get a whole bunch of people that were trying to make more dollars in fiat currency jump into the market because they're trying to beat the system. And so they tend to jump in, and then everyone watches the innovation and they push it a little bit further and a little bit further and a little bit further. And then that brings it all to new all-time highs, and Bitcoin becomes more important, especially when you have trends like the traditional, giving people the understanding of you need to own your own money, you need to spend your own money, and you need something that has a fixed supply. That creates a new adoption cycle. A new bunch of businesses come along. We tend to historically hit new all-time highs. We had that with the same thing happened with the Bitfinex hack in 2016 that led to the innovation of a stable coin that started to get traction, and then Binance came along and they didn't need a bank account. So then we had the whole new cycle. Then we had the ICO boom and bust. And we went through the same cycle again. And then we had big hacks in exchanges like CoinCheck and various others. We did a recovery plan for Bitfinex. We did a recovery plan with Kraken for Mt. Gox. Unfortunately, too much was lost in Mt. Gox. And I think it's a similar position with FTX, but they may have many other assets. And we go through this more defined Chapter 11 process. But the most important thing to get out of this is people are going to make a decision. Your decision is you're either going to lead the market because you were here just for the dollars in the first place, or you're going to stay with the market because you see it as an opportunity to rebuild your future and accumulate more Bitcoin with your dollars. That's the choice that you're going to make. Some people will be stuck in the fiat system, and some people, very unfortunately, got blown up and they're starting again. So you're going to need income. And from here, you're going to need to spend less than you earn and invest the difference. That's your first job every single month. Spend less than you earn, invest the difference. Now, you may be deep in debt. I had to do something when I was deep in debt, which I'll share with you right now. And when I was deep in debt, I had to do something called pay myself first. I read a book by Robert Kiyosaki where I heard about this concept, or I think it was The Richest Man in Babylon, a really old one. It's a really short book. But I was deep in debt. I had approximately £150,000. I was in the UK at the time, and with my mortgage, about 250,000. And I decided that I was going to put a percentage of my income into a savings account, and I held it in fiat, and I wasn't going to pay my debt. Anything that was left over, I would use to pay my debt. And then that was the money that I used to buy the Bitcoin and go to the first Bitcoin conference later. And I was trying to invest everything in my business, but I committed to putting by 10% of my income and investing it in what I thought was going to be hard money. I didn't fully understand it at the time, so I made a lot of mistakes along the way and blew up a lot along the way, but eventually reached that understanding. And then eventually that hard money will go through to the next cycle. We reach the halving cycle in 2024. I can't give you financial advice. I don't believe that this is the end of the market. I will still continue to buy every single month and not change my approach at all. And I will love every day of the bear market because it allows me to take my income that's earned in fiat currency and accumulate more Bitcoin with it. And then when I believe that it turns around, because hard money has a fixed supply, it generates a greater wealth effect, and that wealth effect can be used in order to invest. And then you just get better and better and better, and you join these communities. You learn more. You learn from your mistakes. You learn from everything that's happened here. And hopefully you put together a 10-year plan for yourself that eventually gets to the stage where you only work because you choose to, not because you have to. And there would be nothing more than I would want in the world for that, for everybody on this call. Some of you may be there already. Some of you may not. But the first step is that we need to turn these disasters into opportunity. And the only way to do that is to use the Chapter 11 processes to ensure that you get what money you're entitled to and you get what securities you're entitled to. And then you use that as your starting foundation and build up and build up. As I said, some of you are going to be in completely different circumstances and scenarios. Some of your businesses will be completely affected by money on FTX. Expect to see more. And if we enter into Chapter 7 liquidations, expect to see further corrections and complete capitulations in the market. But I will still continue to be doing exactly what I've been doing from the day I discovered that Bitcoin is the ability for us to own our own money, spend our own money, and have a fixed supply, because it's too important to fail. It should never have succeeded, but we got it this far. It will continue, and it's got nothing to do with FTX. It's got nothing to do with Celsius. It's got nothing to do with BlockFi. It's got nothing to do with Voyager. It's got nothing to do with any of those things. It just is simply a mechanism as savings, and then you can go into investing and take additional risks based upon that. And the regulators are going to expect us to conform to the existing regulations, and they're going to create new ones. And so we as an industry in centralized companies need to embrace that, because actually there's bad regulations and good regulations. The bad regulations we need to lobby against, and the good regulations we need to appreciate that would have prevented this. Celsius, if they did disclosures and if they did suitability, no one would have had their life savings, and everyone would have known what they invested in. FTX, if they did suitable custody and segregation of securities, nobody would have been in this situation where their funds were being used. And with Voyager, if they were actually a securities business, then they would have been through a SEPA liquidation rather than a Chapter 11, to selling to a company that turned out that they were just trying to rehypothecate their debt-based scheme based upon printing money as tokens. So we get out of this, we become wiser, we react to it, and that's my commitment is to still commit to the industry. And I think that this moment that we've got all these Twitter spaces where we're actually able to work together as a community is probably the true gift that comes from this. Because I saw people in the Celsius scenario where they were suicidal and they prevented suicide because of the community of other people that were all in the same situation. So please look out for each other. We always attack each other. We always go through our moments. But we are all humans at the end of the day. We all make mistakes, and we're all here because we're alive at one of the most interesting and exciting times in financial history. Many are going to get hurt, others are going to do really well, and we need to make sure that together we stay on the right side of the change, because there are many other people that are going to get really hurt by this, and they need you as a leader and an example to show how you change and how you react to this and how you use this as an opportunity to change things. Because that is what Bitcoin did, and that's the gift that Bitcoin gave us, and we should respect it. Thank you very much. I'll see you next time.